and the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The Fed keeps high for longer, then we will see that slowly wind its way through the economy.
As long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in.
We will continue to see upward inflation pressure and potentially upward pressure on rates.
You still need to see this softness come through, and we're not seeing it across any of the metrics.
The longer the Fed holds at 5 and change, the risk in the equity market is actually increasing rather than going down.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
You can't blame me for the pessimism when you have the head of the IMF saying things like we may be heading into the tepid 20s. Just want to say, welcome back. Good morning. This is Bloomberg Surveillance from Washington, D.C. for our audience worldwide. Anne-Marie Hordern here. I'm Lisa Abramowitz. Jonathan Farrow isn't still in D.C., but he's down at the IMF, heading there right now, and he is going to be interviewing Kristalina Georgieva about the tepid 20s and maybe trying to make it sound optimistic. But here we are. The market's trying to get a bit of a bounce. And Anne-Marie, I have to say, one of the most difficult things has been trying to square all the gloom and doom that we've heard over geopolitics, over the potential uncertainty in the rate regime, with the fact that ultimately things are okay, and that actually when you look at companies, they're making money and individuals have jobs.
And all this has to do with the U.S. exceptionalism, which is the IMF continuously has been hammering home this entire week, whether or not in speeches or reports. But the cost that they're talking about, the cost of that U.S. exceptionalism on the rest of the world, this loose fiscal policy, does that make it harder then for the Fed to hit 2%? And what does the strong dollar and higher yields mean for the rest of the world. And how do they deal with that?
And frankly, right now, when I take a look at all of these highfalutin speeches, there are probably a lot of people who just tune out. They say, okay, we hear this all the time. It's lots of job owning. What does it actually matter? I thought John Lipsky was really good there when I said, is the IMF not relevant anymore? And he said, just even to have a conversation and to have people come together and have these discussions, to have South Korea, the Japanese finance minister, and Treasury Secretary Janet Yellen coming together to talk about currency concerns is better than not having those conversations. And that is definitely what we see going on here in D.C.
The question is, they know the concerns are there, and these are serious concerns, was what the Japanese foreign minister said. They're not just regular concerns, they're serious concerns. It seems like the Treasury Secretary agreed because she put her name on that readout. But what does it matter? What are they going to do?
Honestly, this is one of the big challenges for a lot of central banks, and it's not just the Bank of Japan, it's also the European Central Bank. We're going to be speaking with Klaas Knot of the Dutch Central Bank, but also of the ECB, and he is a governing council member at a time when there's a real question about how Europe responds, given that their economy is not expanding to the same degree that the U.S.'s is. And frankly, the euro is okay here, but potentially problematic if you start to get an oil surge and all of a sudden that weakness versus the dollar starts to bite a bit more.
Absolutely. With Europe, it's not just the USD, it's crude, and how much that impacts what is going on in the European market. And how do you fight both the Fed and potentially two hot wars in geopolitics?
There's a lot to worry about. If you took a look at markets, you would have no idea because basically people aren't doing anything in particular. You are seeing a bit of a reprieve after the longest sell-off that we've seen in the S&P going back to the beginning of the year, up about 0.25%. But the nature of the decline was interesting. It shifted around a bit with different reasons. It wasn't just higher yields because they did reset a bit lower yesterday. You are seeing a bit of a reprieve from the dollar strength that just came through in a rip-roaring way with the euro regaining just a little bit. But again, this is stasis, 106.78, 10-year yields really hovering up against the 460 mark, but really calm relative to the past few days. And crude coming in a bit lower, about 0.5% lower. Just again, 82.28 on WTI. A question of at what point we're actually baking in risk premia tied to the conflict in the Middle East. Coming up, Dutch Central Bank President Klaas Knot, and why he's still penciling in a June ECB rate cut. Jonathan Pingle of UBS on why he doesn't see the Fed cutting until September, and a pretty bold call on what could happen if they don't. And IMF Managing Director Kristalina Georgieva joining Jonathan Farrow on the organization's latest global growth outlook at a deeply uncertain time. Let's start with our top stories. Stocks steady as investors shift focus from geopolitical tensions to the Fed's next move. Ed Yardeni of Yardeni Research saying this: the geopolitical environment is certainly foggy and full of uncertainties. More certain is that the Fed will remain in no rush after hotter than expected March CPI and better than expected retail sales. Higher for longer interest rates shouldn't be a big negative for the stock market if the reason for them is that the economy continues to perform well. Ed joins us now, and I'm so pleased to say he is here. Ed, always a pleasure speaking with you. Thank you for being here. Do you think right now yields are still rising for the right reasons?
First, let me say I don't think it's going to turn out to be the tepid 20s. I still think the most likely scenario is actually the roaring 2020s. I think that the reason yields are rising is because the economy continues to perform very, very well. I think the economy has demonstrated that it's resilient. The economy has demonstrated that it can live with these interest rates. And these interest rates are really back to normal. Prior to the great financial crisis, through the great virus crisis, prior to that period, which was the great abnormal, in my opinion, we had interest rates around these kind of levels. Now, of course, some of the increase in interest rates recently has been because the markets kind of come around to an opinion we've had for a while, and that is at most you're going to get 2 to 3 rate cuts this year, but increasingly we've concluded that there are going to be no rate cuts this year whatsoever because the economy is doing well, and we still think inflation is moderating.
There's a lot there to unpack, Ed, but I want to just go to the roaring 20s versus the tepid 20s. Can you have a roaring 20s in the United States with a tepid 20s elsewhere in the world?
So far, so good. I mean, that's really been the case. And by the way, one of the reasons we didn't have a recession over the past couple of years is simply because China did it for us. China's had a very significant recession, and their CPI is basically flat on a year-over-year basis. Their PPI is down 2.6% on a year-over-year basis. And if you look at the prices of goods we import from China, they're also deflating. So China's helped to bring inflation down quite a bit on the goods side in the United States. So Europe, is in a shallow recession. Well, let's call it a growth recession. It's just not growing much, if at all. And so when you put kind of the global picture together, you get a global economy that's growing, but the leadership, clearly, the tugboat, if you will, is the U.S.
Ed, how much, we're going to be speaking with Klaas Knot of the Dutch Central Bank and also of the ECB. How much do you see the dollar as a threat to that, given the fact that you have the rest of the world weakening and now potentially cutting rates, and the dollar is doing what, of course, it would do, which is rally to a dramatic degree?
Well, it goes back to your previous question. A strong dollar usually is an indication that the U.S. economy is outperforming the rest of the world, and I think that's what we're continuing to see. And that's really been the case since we came out of the great financial crisis in 2009, 2010. We've had a strong dollar. The U.S. stock market has considerably outperformed the stock markets of the rest of the world. And as a matter of fact, the market cap of the U.S. is continuing to gain relative to the total world market cap. So it all suggests that the U.S. economy is actually doing well. So I kind of look at it in the reverse. I don't view the strong dollar as a problem for the U.S. economy. I view the strong dollar as an indication that the U.S. economy is doing extremely well.
What does all this mean, though, Ed, if we were to see a spike, more of a spike, heightened geopolitical tensions? Because your latest note is talking about the fog of war. How do you prepare for some of those downside risks?
Well, look, I think the most likely scenario is the roaring 2020s, but it's not the only scenario. I'm not going to tell you that there couldn't be the tepid 2020s. If I had to put subjective probabilities on kind of decade analogies, I'd say that it's 60% roaring 2020s, like the 1920s. And then I think 20% for a repeat of the 1990s, where we have irrational exuberance, which isn't a terrible scenario. You can make a lot of money on the way up if you remember to get out at the top. And then I give 20% to the 1970s all over again. And that's where that was a prelude to answering your question. It could be the 1970s all over again if the geopolitical situation really becomes much worse and affects the price of oil. And it's not just the Middle East, the situation, it's also Ukraine using drones to take out or at least to impair Russia's ability to produce oil. If we get another energy shock, kind of the second one of the decade, it would be very reminiscent of the 1970s. And then here we go again with the Fed not only not being able to lower rates, but might actually have to raise rates to avoid another wage price spiral. So, you know, I can tell the bearish story. I know the bearish story, but I think at some point you have to put subjective probabilities on this. And for a portfolio, I think it means you need a shock absorber for an inflation scenario caused by the geopolitics. And that would require overweighting energy, which isn't very hard to do because it's a really tiny sector in the S&P 500. But I'd certainly have energy in the portfolio. And I'm not a big fan of precious metals, but in this situation, I think they make sense.
Well, let's go to precious metals. Gold. Ed, how do you describe what is going on right now in the gold market? A lot of people come on the show and they give us different theses as to why they see gold continuing this stunning rally.
Yeah. Well, in some ways, everybody's looking at the same chart. They're looking at the chart of gold, and for a few years, it's consolidated, it's gone sideways, and then all of a sudden, over the past couple of weeks, it's broken out. And that coincided with the war in the Middle East intensifying. It coincided with concerns that inflation remains sticky and that the Fed won't be lowering interest rates. And then, of course, there's a competition going on between Bitcoin and gold. And Bitcoin has done extremely well. And I think there's some investors who are concluding, well, if I want to have sort of a hedge against everything going wild, maybe Bitcoin's too expensive here, and gold might be a better place to be.
When you take a look at the optimism that you paint, you can paint a bearish story, you can paint a positive one, a bullish one. Yeah. If you take a look at the bullish story, How do you sort of explain a broadening out in the rally based on what you're describing, which is higher for longer, that's clearly affecting some of the small cap stocks? And frankly, we're not seeing a particular boost overseas either to the likes of Europe or even Asia.
Yeah. Well, first, let me say I do think that the stock market in the U.S. probably made a short-term top on March 29th. It's had a heck of a move. And some of that move was based on the notion that we're going to have 6 to 7 rate cuts by the Fed. Now the market's looking at 1 to 2 rate cuts, and I think it's going to get disabused of that notion shortly. But I think that on the bullish side, what we have is the market, I think, has started to discount the roaring 2020s. And I know exactly when it did that. It started on November 30th, 2022, when OpenAI introduced ChatGPT, and suddenly the rage was AI, and the AI-related stocks have done very well. I'm skeptical that it's going to be an overnight sensation in terms of its impact on the economy, but so much money is being spent on this technology and other technologies to increase productivity, which, by the way, has been improving, that I think some of it is going to pay off. And clearly that means that it's not just the companies that make the picks and shovels that will benefit. It'll be lots of companies using these technologies to increase productivity. And as I said, last year was a great year for productivity. So, you know, this roaring 2020s is not pie in the sky. It's not, you know, trust me, it's going to happen. I think it's already starting to happen in some areas of the economy.
So just to sort of tie this all together, Ed, basically you're looking at a bit of chop as people price out any rate cuts this year. So you're in the no rate cut camp, possibly. But then they sort of reassert on fundamentals. Is that correct?
Yeah, the economy does well, and that surprisingly, relative to current thinking, inflation does in fact continue to moderate. And I think we'll see that in the PCED.
Ed Yardeni of Yardeni Research, thank you so much for being with us. Always a pleasure. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Norway's $1.6 trillion sovereign wealth fund fell short of its benchmark in the first quarter. It was weighed down by both fixed income and real estate, but to the upside, equities, especially tech. The Norges Bank Investment Management Deputy CEO told me earlier this morning on Bloomberg Brief that despite those tech gains, they're not willing to go overweight the sector.
It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful.
You can watch Bloomberg Brief every morning at 5 a.m. Eastern. Elsewhere, Donald Trump's presidential campaign wants other Republicans to pay up if they use the former president's name, image, or likeness in any fundraising. According to a new campaign memo obtained by Bloomberg News, all candidates and committees who use Trump in their fundraising appeals must give a minimum of 5% of the money earned to Trump's political operation. House Speaker Mike Johnson is on a fast track to approve a bill aimed at forcing the sale of TikTok. Johnson plans to include it in the aid package for Ukraine and Israel that he's teed up for votes on Saturday. 2 Republicans have threatened to try to oust Johnson over the foreign aid, but the speaker is still pushing ahead. Attaching the TikTok measure to the foreign aid bill would force the Senate to accept it as a condition for supporting Israel and Ukraine. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, the ECB opens the door to June.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal.
That's coming up next. You're watching Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
From IMF meetings, we are here in Washington, D.C. This is Bloomberg Surveillance with a little bit of a lift to the market as people take a stock of a 4-day losing streak, the longest since January of 2024. We're seeing a bit of a bounce, although it fades up now just 0.16%. What you could see is the dollar strength fading just a touch, and you could see bond yields pretty much stable. I want to get right to it because this is going to be one of the most important conversations of the morning. Under surveillance this morning, the ECB opens the door to June.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal. We are clearly seeing signs of recovery now, beginning timid and picking up in the course of 24.
Here's the latest. ECB officials gaining confidence to cut interest rates at their June meeting on the heels of downward trending inflation and signs of economic recovery. That timeline contrasting with the U.S. as persistent inflation pushes back rate cut expectations in that nation. Dutch Central Bank President and ECB Governing Council member Klaas Knot joins us now. And Governor, President, all of the different ways that you weigh in on European Central Bank policy. What a fraught moment. How much are you looking to U.S. policy to determine how far the ECB can go on its own?
Well, obviously, monetary policy always takes place in a global context. But at the same time, we're not the 13th federal district. We have our own monetary policy. We have our own set of outlooks, economic outlook, inflation outlook. And as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area. So we have our own monetary policy to do. That monetary policy, I think, is testimony of the fact that we're increasingly confident with the disinflation process that we have been seeing and that we expect to continue. We expect it to become a little bit more bumpy also down the road because of all kinds of technical factors that I won't want to tire you with. But we are confident that the overall picture is one of continued disinflation.
So you mentioned the B word, bumps, and this is something we hear a lot. What kind of bumps would you have to see to not cut rates in June?
Well, bumps that would lead me to fundamentally change my assessment of the ongoing disinflation process. And I think the projections that we have are pretty clear, that we are moving toward reaching our target 2% inflation over the medium term in the remainder of this year, course of 2025. But there are risks surrounding such projections. But increasingly, these risks are becoming more balanced. Upside risks, I think, emanate predominantly from the labor market. And then it's not just about wages, it's about wages in combination with very slow productivity growth. That's also a major difference with the US. And the question about the capacity of firms' profit margins to absorb any increase in unit labor costs that might come from this combination of wages and productivity growth. That's the assessment we need to make. That's a risk on the upside. At the same time, we also don't want to undershoot our inflation target. We have a 2% symmetric target. We are zooming in on it, and let's make sure that we continue to do so.
So right now the market's pricing in a 25 basis point cut in June and then 2 more for the remainder of the year. You're basically on board with that if everything stays the same?
Well, I'm not uncomfortable with such market pricing, but at the same time, we don't pre-commit. We're data dependent. We go meeting by meeting. Of course, we have a picture of where we think the underlying movement is within the data, but we will have new data points, every month on inflation, every quarter on the labor market, and that will continue to inform our decisions beyond June.
Well, what would make you rethink what you have right now in terms of that path? Is it the geopolitical concerns? I'm trying to understand what would make the ECB change path, or how would they respond to, say, an oil price shock?
Yeah, well, an oil price shock obviously will lift inflation. That is absolutely true. But the question for us is the oil price shock of enough significance to trigger second-round effects? And there's an important difference here today with 2022. In 2022, all inflation items were going up, and we had the energy price shock as the consequence of Russia's unjustifiable invasion of Ukraine. Now, if we have an oil shock, it will be against the backdrop of general disinflation in all the other factors. So the likelihood of significant second-round effects, I would argue, is smaller, but it is clearly something to monitor. It's clearly something to keep in mind.
So you're willing to potentially look through it?
If it continues to be confined to energy prices only, yes. As soon as I get indication that it broadens into the consumer basket into more traditional goods and services inflation, then the answer would turn no.
Something that people have speculated is that the ECB might be willing to also look through depreciation of the euro in response to rate cuts at a time where the Fed is not cutting, as long as there isn't an oil price shock. So let's say that there isn't an oil price shock. Would you be willing to accept parity with the euro and the dollar? All things being equal, it's fine.
Well, the exchange rate in and of itself is not a target of our policy, so I can't comment on specific levels of the exchange rate. It's one input into our overall assessment of the inflation outlook. It's clearly that a depreciating currency would lead to additionally imported inflation. At the same time, if the reason for that is tighter monetary policy in the US, higher bond yields in the US, that would also spill over to the euro area, and we would have tighter financial conditions in the euro area as a consequence of that. Which of the two effects will dominate? It remains to be seen. That's very much state contingency, so that's difficult to comment on beforehand.
A very difficult question. Some people are speculating that high rates are actually helping inflation continue because people are earning more, and then they're able to refuel that into the economy, and that low rates actually were depressive of inflation. Do you believe that?
No, I don't believe that at all. I think it runs counter to decades of empirical evidence, and if you want to see what the consequences are of running such an experiment, look at Turkey, right? I mean, that's where the experiment was brought to life. And I don't think that that's seen as a paragon of central banking success.
Dutch Central Bank President, ECB Governing Council member Klaas Knot, thank you so much for being with us. Really appreciate it. Have fun at all of the meetings and the speed dating that is the IMF and the IIF happening right now, and World Bank meetings for that matter, in Washington, D.C. Coming up, breaking jobless claims and reaction from Jonathan Pingle of UBS, who has a pretty bold call about if you do see a reacceleration of inflation, you could get a Fed that is hiking rates once again next year to potentially 6.5%. Plus, we'll go live to the IMF for interviews with the head of the South African Reserve Bank and IMF Managing Director Kristalina Georgieva. Jonathan Ferro went down there. He wasn't just avoiding us. He actually is going to be conducting those interviews right now in markets. A real sense of calm. I don't know if this is something that's going to be persistent, Anne-Marie, but this is definitely, basically, people don't want to do much and have much conviction about things.
Potentially calm before the storm, though.
Oh, look at that. You've been hanging out with me for a while.
Exactly.
All of those interviews from the IMF, that's later. Coming up, this is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Go to 1,812,000. So still roughly in the same ballpark. Last week, 212 for initial claims, so no change there. We gained about 20,000 for the continuing claims. So there's no story there, except that the labor market is still tight. Philadelphia Fed Business Survey really surprises, comes in at 15.5 after 3.2 last month. Economists were expecting a drop to 2, so that is quite interesting. The prices paid index, which of course is going to get everybody's attention in this inflation-obsessed world, 23. It was 3.7 last week, so last month. So in April, 23. So prices up, labor market tight. Fed, your move.
Well, basically what you're seeing in markets is exactly what you would expect. You get a little bit of inflation fear, you get ongoing strength in the labor market, and you push it through the bond market, and you get higher yields, marginally so. This isn't a massive move, but still, it's the direction of travel. Of 460 once again on the 10-year. 2-year yields climbing to 496. And what we can see is, frankly, stocks are taking this in stride. Again, this is a yields rising for the right reasons that we heard from Andy Ardeni, and really not much movement at all. In the currency market, though, and this is where I think things get very interesting. Ongoing American exceptionalism is bad news for a lot of other central banks, and that's what you see ongoing. That dollar strength continues to reassert itself. The euro had been gaining. Now we are once again reverting to negative on that currency pair. Mike, I want to talk about the Philadelphia Fed business survey. How much are we looking at some of these peripheral surveys to give us a better sense of the picture? I was reading the Beige Book yesterday, and it sounded like missives from 100 different countries. How much are we getting a consistent story?
Well, the Beige Book was very interesting because it was much gloomier, I don't know if gloomier is the word, but less enthusiastic about the economy than Fed officials have been, saying that the economy is growing slightly and that prices have leveled off and people expect inflation to keep going down, which doesn't seem to be the reality that we're seeing. Now, the regional Fed numbers and surveys, they're regional. They don't necessarily tell us a lot about the whole country. And we see the ISM number come in once a month that can frequently undercut all of that. But with the focus on inflation and on whether the economy is coming back, people are looking at to see what the strength was in the Philadelphia and New Jersey area and what the inflation situation is, and it's all clues that kind of go together. But I don't think you're going to see big market moves on this. Wait till next week when we get to PCE numbers.
A lot of people are going to be looking to that. Michael McKee, stay close, please. Right now, I want to bring in someone who we've been talking about all week. Jonathan Pingle of UBS. He came out with a call that was nuanced, and I think that that's the important way of putting it, and I want to start there. You talk about how your base case is 2 rate cuts, but you made headlines by talking about the possibility for the Fed to raise rates to 6.5% next year. Put those two stories together. Please explain.
Well, I mean, the stories are, I mean, I hate to admit it, they are somewhat born out of our own forecast errors, right? So I think there's an element of needing to be humble here, but I mean, the basic fact is growth has surprised persistently, for the last year or more, essentially. And, when we think about the central bank, we're all focused on inflation. They're very focused on inflation. But in the backdrop, they have this very strong labor market, strong headline numbers, retail sales. And at some point, if that is really what's preventing them from achieving their inflation target or making further progress, at some point they may need to push back on that. And pushing back on that would imply something, I think, a little bit more than just higher for longer, where they maintain the same level of rates and hope that that slows growth and they make this grinding progress down towards 2%. Because if the economy is going to remain sufficiently strong, I mean, non-farm payroll employment, 303,000, extraordinary number. But even if it's still running at this 244 average pace, eventually the unemployment rate is going to start moving lower. And that seems pretty inconsistent with 2% inflation. At some point, the central bank may think they need to do something about it.
Are you basically saying that if inflation doesn't come under control, the Fed's going to have to break something?
This isn't even about breaking something. I mean, this is like going from 244 to something closer to trend. I mean, it's really an extraordinary pace of growth. It's persisted for a while, and they might think that they need to break something in order to solve this sort of, I've been calling it sort of the last half-mile problem, like if they're stuck at 2.5. But I think if growth is going to be 3% GDP growth and 250 on payrolls, I mean, they're just, I think, they're going to end up coming to the realization that that is not going to allow them to achieve price stability.
We heard from Michelle Bowman last night saying she thinks policy is restrictive, but maybe time will tell if it's restrictive enough. When you see these kind of numbers in this kind of market and you have a probability, even though it's small, you are putting in a probability of a hike. Do you think the Fed is restrictive?
Well, I do think the Fed is restrictive, but I have to say I've been thinking the Fed is restrictive. And at the same time, I'm still not seeing the kind of slowdown I would have expected. I mean, you do see some evidence of restrictiveness. I mean, equipment investment, I mean, a lot of different types of business fixed investment have been pretty weak. And that looks like it's the effect of higher interest rates restraining that activity. But overall, when you're watching consumption growth at the pace we've had it, it's very difficult to think that, well, you know what, is the neutral rate really the 0.6 in the SEP? So we've started thinking about a short-run neutral rate, but I will say it's hard to identify these things in models. It's hard to come up with a point estimate. So the Fed and we are really feeling our way forward, and I think as we feel our way forward, I mean, if growth is just going to remain super strong, at some point they might realize they need higher rates to kind of, tame the economic conditions that would engineer a path to 2%.
But back to your base case, you did push back your timing, though, of that first cut to September. A lot of people are saying September, right?
Yeah, no, we did. I'm only laughing because we got the CPI, and I actually published the rate call change faster than we published our CPI write-up.
But why are you even having 2 cuts if this is what you're talking about?
Well, we have 2 cuts because we do think the economy is going to slow. I mean, we're looking at an expansion where the sources of growth have been relatively narrow. So we look at 2023, and we think there was a big impetus from fiscal policy. And we think we're seeing that fade, both in the pace of manufacturing plant construction that was supported by the CHIPS Act and the IRA, as well as sort of what we're seeing in public infrastructure investment, for example. And we're also seeing a fair amount of hardship in households. And we think that that is the recipe for a slower second half. But we've been thinking that that's a recipe for slowing. And the upper 20% of the income distribution remains awash in cash, liquid assets, and high levels of wealth.
So I think that Anne-Marie was going to September and this question around politics.
Of course.
Oh, yeah.
Because there's...
You're in Washington.
So, here we are. People are saying, can we actually get a September rate cut given the fact that we have one of the more contentious elections that we've had in a very long time? How do you push back and say, okay, if the economic fundamentals determine that this is the way to go, the Fed will just do it? Is that really realistic based on the climate we're in?
I think it is. I think it does put the onus on their communications to explain why it's unfolding. But when we look back at history, we've sort of analyzed the September moves. I mean, we can debate whether or not the start of a cycle is different than an ongoing cycle, but they do move in plenty of Septembers within 3 months of a presidential election. I just think their communications have been such that they've laid out this plan. They've been telling everybody that I don't think it would be particularly surprising if the data started to go their way. They're communicating it. I think November would be a challenge, 2 days after the presidential election. I mean, could you imagine waiting and then doing that? So I do think the odds of November should be pretty low to start an easing cycle, but I think September is probably okay.
Jonathan Pinkel of UBS, thank you. That was really interesting, especially given the fact that people are starting to rumble about the potential for a rate hike at some point. Right now in markets, all is calm. You are seeing a bit of a reset in bond markets in the heels of some of that data, with yields now solidly up a whole 2 basis points, 460.80. You are seeing that not necessarily affect badly on stocks, still up 0.2%. I don't want to delay. Let's head over to the IMF. Jonathan Ferro did get down there. He is currently alongside the head of the South African Reserve Bank. John.
Hey, Bramo, thank you. I was just going to say there's a man next to me who probably doesn't want the Federal Reserve to hike again anytime soon. I can catch up with my old friend, Governor Lesetja Kganyago. Governor, thank you very much for being with us at the IMF.
Good to be here.
Inflation comes down to 5.3. The market, the general estimate, the consensus estimate was 5.4. First question, you cutting interest rates off the back of a downside surprise like that?
Well, we had 5.3 as our forecast as a central bank. And I guess that the fact that the markets get excited that the print had surprised them by 0.1 just tells you the extent of the uncertainty that we are in. We have not quite seen a discernible trend because we had peaked at 7.8% in 2022, and we were coming down nicely. We went all the way to 4.7, and then we started to go up again, and it rose all the way to 5.6, and we are now at 5.3. There isn't a discernible trend, but a look at the components of inflation makes for an interesting read. Food prices have continued their downward trend. They might be reaching the bottom. It's too early to tell because we do not know the effects of El Nino. Core has also now come down to 4.9%, and we hope that it sustains that momentum. And so too early to tell what a discernible trend would be.
Speaking of upside surprises or small surprises and big reactions, saw a similar thing in the United States last week, the other way around. You had a downside surprise. US CPI came in a little bit hotter than expected, and all of a sudden, the markets, big moves in rates, dollar a whole lot stronger, and big questions about central banks abroad and the consequences for them. Could you give us a bit of colour on that, Governor? What are the consequences for you? How independent is your policy from what the Federal Reserve may or may not do in the future?
Well, we watch the Fed, we don't follow the Fed. The decisions of the Fed reflect a key institution's take on the U.S. economy, which is the largest economy in the world. We are a small, open economy. The actions of the Fed have an impact on global financial conditions, and global financial conditions have got implications for the direction of capital flows, and thus a realignment of exchange rates. And actually, at our previous, many of our meetings in the past, we had highlighted that the tight global financial conditions have got implications for the exchange rate, and by extension could lead to an impact on domestic prices. There are a range of other factors, but we do not follow the Fed. We watch it. We started tightening policy a good 12 months before the Fed started doing it. We started in 2021. The Fed only started in 2022. But the actions of the Fed have got huge implications for global financial markets.
Big implications for the FX channel as well. The rand's actually been pretty stable against the backdrop of a much, much stronger dollar. Why do you think that is?
Difficult to tell. This currency gets everywhere. I think that there had been a lot of negative news that had gone into the rand. There's been a lot of uncertainty, and when I talk to market players in South Africa, I said there is an uncertainty about the elections, and I said that more than half of the world population is voting this year. What makes the South African elections so special? I said, well, the one thing is that for the past 30 years, all that we knew was one governing party, and now there is a possibility that we might end up in a coalition. And if you end up in a coalition, who do we end up with a coalition with? And this is a lot of uncertainty, which then says that the elections behind us, and now everybody knows exactly what the political outlook is. And if the concerns had been about that, that means that it takes away massive uncertainty. For us as a central bank, we have just been looking at the data and whether we are picking up any discernible trend from the data.
You mentioned the politics. I didn't. So let's talk about the politics. You've got an interesting calendar ahead of you. I think the end of May is the election, and your policy decision is a day after. Is that right?
Yeah, that's correct.
So the conversation we're having in the United States, I'll give you some color on that, and I'll tell you what it sounds like, and I'm sure you're familiar with it. There is this belief that the Federal Reserve won't really do anything around the election, that because they don't want to get political, they'll avoid politics, but at the same time, they're considering politics to avoid being political. How does that work for you?
Well, we are very clear. This is an interesting thing. We release a calendar of our policy meetings a year in advance. We didn't know when the president will pronounce an election, and he announces an election bang in the middle of our policy meeting. We have got to look through that, and there is a reason why we are focused just on data, and we are taken away from the political cycle so that we can actually make technical decisions and not be affected by the political cycle. But there is also something. The president decided to insulate the Reserve Bank from the political cycle by taking a decision about the renewal of my term and those of my deputy governors and the term of the Commissioner of the South African Revenue Services. Make those decisions ahead of the elections so that it does not get affected by the political cycle. So we make our decisions based on data, based on our outlook for both growth and for inflation.
So congratulations on a second term. I do have a final question though. The conversation with the Treasury about a new inflation target, where are we with that? And do you expect to come to an agreement sometime soon?
There should be an agreement, but I don't expect anything to happen before the elections. This is not like our policy calibration decision. This is about the framework and making changes on the framework. The Treasury had commissioned a macroeconomic review, and as part of the budget documents, they did release a document on the macro review, including the consideration of the lowering of the inflation target. That is a conversation that we would continue. The manner in which the process works in South Africa is that the minister makes the announcement about a target, but there is a process towards that announcement, and that process is a technical process between the Reserve Bank and the National Treasury.
Governor, you've been very kind to give us so much time. Thank you very much for being with us here in Washington, D.C.
It's always a pleasure talking to you, Jonathan.
Thank you, sir. Lisa, I'm going to throw it back to you at our headquarters here in Washington.
Great work. Thank you so much, John. A great conversation, especially given the fact that people all are watching the Fed, but they are their own entities. And oh yeah, about politics, well, we're data dependent. Right now in markets, we are data dependent as well, and we are seeing the data coming in a bit better than expected. The read through to markets is basically very muted on futures. You see S&P futures up about 0.1%, but pretty muted as well on bond yields, up just marginally 1 basis point. It's basically pretty much a stasis after a whole host of a dramatic couple of days. Coming up, don't miss this, IMF Managing Director Kristalina Georgieva.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg, context changes everything.
Guess what? We got more data out of the United States, and guess what? It was better than expected, with jobless claims having the right kind of downside surprise, as John would say. You're coming in below expectations, and what you can see in markets is basically that what's good news for stocks is bad news from bonds once again, but on the margins, not a huge market mover or shaker. What you are seeing is S&P futures up, though, 0.2%, and we've been talking about this. The fact that we got the biggest downside surprise or the biggest downward streak in equities, the fact that it wasn't that much shows you where we've been. 50.71 on the S&P, a bit of a dollar strength. You could see that with the euro down just a touch, 106.64, with that whole U.S. exceptionalism story. Oil, interestingly, down just about 0.16%. And basically this question of at what point will geopolitics rear its head once again in the crude space. Under surveillance this morning, the challenges for global growth. Earlier, we spoke with John Lipsky, formerly of the IMF, about the rising risks to free trade and how emerging markets can catch up.
The U.S. is, as the IMF World Economic Outlook pointed out, is performing in an exceptional way. The question is that sustainable or temporary? Is it produce as we said, you said just a few minutes ago, the IMF called it overheating. But that's not so obvious in the data. And the IMF's own figures point to an easing in growth in the U.S. next year. So it seems to me that it'll be more important to look at the underlying causes of stronger growth in the U.S. Why is growth in the advanced economies is weak, and in the emerging and developing economies falling far behind? As the IMF pointed out, only the U.S. has got GDP output at this time above what had been expected before the pandemic. Everywhere else is behind, and for the poorest countries, they're the furthest behind. In other words, scarring has been important, and more important for less developed countries. This was going to require not just rhetoric, but some deep thought and action of how to boost productivity and growth in these countries. Recent developments have shown is the importance of multilateral institutions as a place for dialogue. Obviously, we're going through a very difficult time. I think back to my period at the IMF during the global financial crisis. There was a real sense, if we don't hang together, we will all hang separately. And you didn't have a sense of great power conflict in trying to figure out how to move forward. I think what we're seeing now is an environment of conflict of still uncertain degree, that the global economy is not performing well. As the IMF points out, global growth is slowing. I think that it's going to take, obviously, return to effective multilateral action, open markets, open financial markets, open trade markets to get global growth back growing again.
It was a great conversation at a time where we've been talking a lot about how U.S. policy, in particular Federal Reserve policy, affects the rest of the world. And we talk about exceptionalism. Michael McKee is still with us, and I do want to go to you on this idea of the rest of the world is watching the Federal Reserve and thinking a lot about it. They might not be directing policy as a result of it, or they won't say that they are. How much is the Fed watching the rest of the world?
They're watching it in terms of feedback loops. If something happens overseas, say the European economy slows down significantly, and then trade with Europe slows down, and so that becomes a problem for the United States in terms of our exports. But the world looks at the Fed because the Fed sets the world's interest rates, basically the baseline for all of the developed countries.
What did you make of Treasury Secretary Janet Yellen saying that she's watching the dollar strength?
That's a little concerning. Those of us who were around in the Lloyd Bentsen, Bob Rubin days remember what happened when Treasury secretaries start musing about the dollar, which is why they've all stuck to this line about a strong dollar is in the U.S. national interest without ever defining what a strong dollar is. The problem that a lot of people see, and I've been talking to a lot of people, obviously, in Washington because of the IMF and World Bank meetings from other countries, is the big budget deficits in the U.S. are going to cause markets to demand a higher premium, which pushes U.S. interest rates up irrespective of the Fed, and that means the dollar gets stronger. And more people will want to invest in the U.S. because rates are higher. So we get all this dollar strength. The rest of the world gets left behind, which is why you'll hear a lot this week, I think, from the IMF and from a lot of the investors who are in town about how the U.S. needs to address its budget deficit.
Well, they had a serious concern in the report. It was a rare, almost criticism of the U.S., saying the U.S. has exceptionalism because of this fiscal policy. How difficult is that going to be this week for, John put it really well, a number of complaints lining up, not behind so much Chair Powell's door, but Secretary Yellen's door?
Yeah, I don't know that it has a lot of influence. The United States is the largest shareholder in the IMF, but doesn't particularly care what the IMF thinks about its policies. So they will go on and do whatever they can. Now, obviously, the presidential candidates and congressmen are paying lip service to the idea of reducing the deficit, but will they really? That's going to be the issue.
And how an election year? Yeah, and how they do is going to be really key. Coming up tomorrow, we get to have a continuation of these conversations, in particular having to do with trade. U.S. Trade Representative Catherine Tai is going to be joining us, Banco Santander Chair Anna Boyden, and IMF First Deputy Managing Director Geeta Gopinath, all joining us to talk about the myriad crosswinds. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Crenny in for Jonathan Farrell. Countdown to the Open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrell.
Coming up in the show, stocks rebound following 4 days of declines. Futures lose momentum as the markets digest the latest data and traders prepare for another busy day of Fed speak. Quick snapshot of high-risk looks at this stage. We're grappling for a base level in these equity markets. The chips went into correction yesterday. The bond market, have they already priced virtually no change from the Fed? Here you go. S&P futures up 1/8 of 1%. 10-year yields tick up 1 basis point. Crude up 0.5 of 1%. Again, you are looking at inventories building in Cushing, and you're looking at demand for gasoline on the low. So we are just looking at a less fraught geopolitical situation right now. And the Philadelphia chip gauge, NVIDIA, is down more than 10% from its peak. You're going to get a whole rolling set of narratives about buying the dip in some of these tech stocks. Let's get to Washington. Jonathan Farrell is standing by with the IMF director. Jonathan, good morning.
Hey, Manus, thank you, buddy. Good morning to you. Standing by alongside me, I'm very pleased to say, the IMF Managing Director, Kristalina Georgieva. Kristalina, thank you so much for hosting us here in Washington, D.C.
My great pleasure.
You and I have got a lot to talk about, and hopefully we've got enough time to talk about it all. So let's start here. The biggest risk to global stability right now, is it right here in the United States? Is it U.S. policy?
Well, U.S. policy has helped the world. Let's start from there. During the pandemic, the fact that U.S. stepped up meant a lot in terms of stabilizing the world economy. And today, when we are upgrading our growth projections from 3.1 to 3.2% to a great degree, thanks to the United States. This being said, all eyes are on the United States. One what is going to happen with inflation and interest rates? Two, how is the U.S. going to navigate this world of more intrusive government policies?
Let's talk about the FX market to begin with. I wonder how happy the Japanese are. I wonder how happy the South Koreans are, the Malaysians, the Indians. I go through it one by one. In the FX market, as you know, Kristalina, we've got a record low for the rupee. The Malaysians have had to intervene in the FX market. The Japanese, the South Koreans are threatening to. Can you give me just a decent impression of what that's been like at the forum so far, the spring meetings? What have they said to you about that? How loud are the complaints?
Of course it is concerning because, as you said, when the dollar is up, many other currencies are down. Not all, but many other currencies are down. And what that leads to is concern about how long that may last. So that's what I hear from countries. How long would the Fed be stuck with higher interest rates? And when they start easing, can we expect that this would take the interest rates in the United States down a little faster? And the answer to these two questions is not an easy one. On the interest rates, the Fed is doing the right thing. They're watchful. Keep your eye on the ball. And at this point, the ball is bouncing up and down, and the Fed is not yet prepared, and rightly so, to cut. We still remain optimistic that within this year, conditions in the United States would allow the Fed to start cutting. For how fast, I don't think that we should gear up for rapid decline in interest
Can I jump in and
rates.
ask you what you think the source of that optimism is? What's behind that? What leads you to believe that those interest rate cuts are coming?
Well, what we're seeing is the economy is indeed slightly overheated, but part of it comes from the fiscal stance of the United States. So there is room to cool a bit the economy just by being more watchful, and it would help the United States overall because, as we know, deficit has gone up to 7%. The second reason is that so far the business environment in the United States has not reacted very firmly to the interest rates being high, but we see a little bit of softening underneath, especially in SMEs. And that tells us that high interest rates ultimately bite.
Can I tease that out just a little bit more? Are you effectively saying to us that the US exceptionalism that so many people are talking about is ultimately unsustainable?
I didn't say that.
I'm asking.
I would tell you what are the sources of this exceptionalism, and I think they're with us to stay. One is very deep capital markets. People are coming here not only because they can generate more income with high interest rates. They're coming here because the economy is very vibrant and capital markets are deep. Second, innovation in the United States moved very quickly from idea to a venture and then to scaling up. And three, the US is tapping into a very vibrant labor force right next door. What in the eyes of many people is a problem, and I admit there are elements of this flow of people that is concerning, is actually feeding into the labor market of the United States in a way that keeps wages lower than in some other countries, and keeps the ability of businesses to grow basically unlimited.
You understand why that's a difficult political message, don't you?
Of course, and I would translate it in the following way, something that I think everybody in the United States is looking for.
Yeah.
Good, sound, transparent immigration policy. The US, if you look at the sources of growth on the labor side front, it is more people coming from outside that fed this exceptionalism of the labor market. But it has to be regulated. It has to protect the American people from those who may be coming here with bad intentions.
I can tell you something that's politically popular in America and elsewhere too. It's going after China. Excess capacity and potentially dumping goods on the international market. We're not just hearing that complaint from the United States, we're hearing that complaint from others as well. What's your message for the Chinese government at these meetings with those concerns in mind?
I was in China recently, and my message there is the same I would convey today. China is on fork on the road. They can continue with their traditional policy, and that includes industrial policy on scale towards export, or they can shift gear and concentrate on domestic consumption, on beefing up demand, and on continuing with market reforms that served them well in the past. We know from experience that industrial policy often produces misallocation of capital and labor. We are today in a world of weak growth prospects. The last thing we need is more misallocation of capital and labor.
The last thing we need is exactly what we've got, I'm afraid, Kristalina, because we're seeing industrial policy take off in America. We're seeing the Europeans trying to come up with their own form of it. It might take them a while. We know how Europe works. China's been doing this for a while. What you just said about China, I heard a decade ago, you've heard for the last 2 decades that they're going to shift this economic model. It doesn't appear that they are. I think a big question for us at these meetings, and I'd love for your input on this, I caught up with John Lipsky this morning, and I said, how does the IMF retain and regain some relevance in this conversation to help reshape these outcomes? Because we're drifting away from free trade. We're breaking away from cooperation. We're going somewhere else.
Well, 2 responses. One, how do we, I wouldn't say regain, because I think we have quite a lot of relevance on that conversation on fragmentation and the benefits of an integrated global economy. We just have to continue to bring the facts in objective manner. And the facts are that when we go excessively in protectionism, in industrial policy measures, we risk to actually affect negatively prospects for growth, and we certainly create a wave, a down spiral, because experience tells us every measure of protectionist nature has 75% probability of reciprocity, and then where do we end? But the second point I want to make, and I'm making it most sincerely, we are in a world that is faced with massive transformation, the digital transformation, the clean economy that we aspire for. There is some value in using industrial policy to accelerate decarbonization, to make it so that the benefits of the digital economy are more fairly shared across society. In other words, when there is a market failure, yes, it is justified. You take a measure to correct it. Our worry is that when we looked at the massive increase of industrial policy measures, a good chunk of them do not reflect the market failure. So we will continue to speak truth to power.
Let's talk truth to power right now. We've got some spies around here. They know they saw you with the central bank governor of China yesterday evening. Can you tell me what you said to him?
What I told him is twofold. One is that China needs to continue to seriously address the problems of the property sector that have been handled somewhat, but not resolved. They need it for domestic consumer confidence, because many Chinese people think of their apartment as their saving for old age. They also need it because a sector of that significance cannot be put on hold. The second thing I told him is that we are now starting our Article 4 consultation. This is our annual taking the pulse of each economy with China, and that it may be very useful for China if we do more analysis on how they can boost domestic demand, how they can exercise their own decision for a dual circulation economy. And I was delighted that he sees value from the fund to get deeper in these issues and provide China with appropriate advice.
They're coming under pressure, you know, they are politically, not just from this administration, Secretary Yellen, but potentially another Trump administration as well. Do you have any concerns that they'll lean towards the FX market and just seek out a weaker currency?
Well, we haven't seen signs of that. But what I do believe is that, yes, if China builds overcapacity and pushes export that create reciprocity of action, and then we are in a world of more fragmentation, not less, that ultimately is not good for China. China wants an integrated global economy. Therefore, what I want to see China doing is to get serious about reforms, get serious about demand and domestic consumption.
We've got so much to talk about, but unfortunately, I know you've got other things to do. Let's continue this conversation through the year. Kristalina, thank you so much, and congratulations on a new term.
Thank you. Look forward to continuing.
Thank you so much. The IMF Managing Director, Kristalina Georgieva. I'll throw it back to you guys.
Jonathan, thank you very much. Great conversation there. A lot to chew on, from currency risk to reform within China. The whole team are in Washington over the next couple of days. We're going to catch up with Chris Ellman. He's been listening into that conversation from CalSTRS. That's next on Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Listening into that conversation at the IMF meetings to the head of the IMF is Chris Ellman of CalSTRS, joining me now on set. Good to have you with us. We both sat listening to that, some very clear messages from the IMF to China, which is about rebalance, stimulate internal demand, and don't bank on any fast and furious rate cuts from the Fed. I think three very important messages. What matters the most to your world?
China matters because it's the second largest economy. It's not a huge holding in our portfolio, but we've got to recognize its place in the world is so critical now. And I thought the comment about the housing market was very interesting because it's been a problem for a long time. They really need to manage that properly. And the focus internally into China's domestic economy, we know from just what our general partners and our asset managers have said is dominant in the Chinese government, and their focus of the party is their own economy. And it needs to be strong. It's a big chunk of the world.
Because that permeates not just to perhaps your overseas allocation, but also here to the US as well.
Well, exactly.
They've got to get it right. Big macro policy response from China seems to be something of you know, the early 2010s, 2011s, and that's not the policy road it looks as if we're traveling.
Well, and you look at, it's amazing how many people they've taken from poverty to middle class, but now they have this gigantic middle class that wants employment, wants stability in their housing prices, and that's taxing all their efforts.
Now, when it comes to managing massive amounts of money, there's you, and then there's the Norwegian Sovereign Wealth Fund as well. And earlier today, I caught up with Trond Grande, Deputy CEO of the Norwegian Sovereign Wealth Fund, and this is what he had to say about tech.
It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful.
Well, from macro policy to equity allocation, it's a swift pivot. But I thought it was an interesting salutary warning about how expensive tech has become. You have your allocation to tech. How much more cautious are you becoming on that allocation? How much caution do you have around technology? All hail NVIDIA.
I'm cautious all the time. Well, and you know, let's recognize he's what, 5-6 times my size. So, and they own the equity market. So technology is not just in U.S. equities and just in equity. It's in our private equity portfolio. It's in our real estate portfolio. It's in our infrastructure portfolio because of the energy demand on technology. And I agree with his concern about valuations. It is priced to perfection, but we are literally, I mean, Jamie Dimon said it's equivalent to the steam engine. I'm not that old, so I don't know, but maybe the invention of the light bulb? I mean, that dramatic. The hope for AI is probably overpriced and overshooting, but it really is a dramatic change in technology that will affect all of our lives. I have no question that a year from now, we'll be shocked at how many types of AI products we are using and maybe not even realize it. So I think that they're overly optimistic, but they have a reason to be optimistic.
But you would say from the macro policy point of view, perhaps we're over hoping for the productivity gains that come from AI. That is your cautionary point, isn't it?
Well, always. The markets overshoot. They're over-optimistic about especially new technology. And I worry, you know, the difference this time is companies are making real money on these things. And giant companies are leading this effort. This is not like a .com era where we have, you know, flyinyoursuit.com and every crazy idea. This is Amazon and Google and Microsoft and Apple leading the charge.
I would just say that Dan Ives was with me. He said it's a get out the popcorn moment for tech. It's going to flex their muscles, and we're going to look back at this mini dislocation as perhaps being one of the greatest buying opportunities. Is that a stretch too far?
Yeah, well, I would say so, but you need a market. You need somebody who's going to say that, because there's also somebody like this week who's selling it. So you need both sides. Look at how far the market has come this year alone, and mostly based on that Magnificent Seven. It's overly optimistic, but that doesn't mean that it shouldn't be optimistic.
The same question for you as we had for Norges Bank, which is 70 basis points hike in rates in the 10-year bond yield. A lot of that is over the past month.
Yeah.
Is the worst of that bond ride over? Is that a moment, a Damascene moment for the bond market, that it recognizes that you're not going to get fast and furious rate cuts from the Fed? Are we done on the worst ride in the bond market?
Tough to always call a top in the market. I thought Vanguard's point today that it could actually, the 10-year could back up to 5%. I was really shocked to see that line, only because the market was so optimistic at the beginning of the year with 6 rate cuts. Now we're down to 1, and the equity market has taken it in stride. So I haven't been popular, but I've been saying for over a year, you've got to take your cues from the bond market, not the stock market. And the bond market is telling you that rates are going to stay higher for longer. And, you know, with the IMF, the interesting question, a rate cut, back to where? What is the base rate? It's not 0. I think the base rate is probably higher than 3, probably 4. So, and right now the economy is doing great with rates at 5. I don't know if we need to cut.
With that in mind, again, we've seen the repercussions of higher for longer. I would say the beginning of the repercussions of higher for longer. One of those is the commodity trade. One of those is the inflation trade. How are you and the board and the investment committee looking at inflation protection moves, additional inflation protection moves within the fund?
We actually have that as an asset class because we recognize that inflation is going to be sporadic, but it is higher for the next 2 decades than it was in the prior 2 decades.
Right.
And for traders, generally in this work environment, that's a surprise to them. I've been around long enough that I know inflation can be persistent and higher. So I think investors, particularly retail investors, are going to have a hard time finding inflation-protected securities in their IRA, in their portfolio. Physical assets like real estate do okay, but we're seeing inflation jump up in different ways. And I think people need to look back at fixed income. It's an investment opportunity and it belongs in your portfolio. That nice steady income is nice to have as the markets ebb and flow. We haven't had a recession in a long time, so I think people really need to be more balanced in their portfolio, and that's what we're trying to do. Physical assets like infrastructure, as well as real estate and other opportunities. It's got to be a blend.
Again, the narrative around commercial real estate is that it's been a tough time. It's been turbulent. There's been moments of existential angst, to say the least. Would you be inclined to take opportunity if there are major drawdowns again in commercial real estate? To take opportunity. Norges Bank are prepared to. So what's your view on real estate?
Well, in Norges Bank, I mean, when you look at their portfolio, they're primarily 7%. In public markets securities, just starting to go into what I would call private market securities, real estate, private equity. At their size, that's enormous. And within real estate, you've really got to bifurcate that market. The office market, no question. That was changed because of the pandemic. That is a new existential change on what does office mean. Manhattan's packed. I get it, so office is fine here. But in the middle of the country, office is vacant oftentimes for huge parts of it. But other parts of real estate are very attractive. Warehouses, apartments are still in high demand. And now you're looking at subsegments of student housing, senior housing. For us, we're big in the biology and life sciences buildings, very specific type structures. So real estate has still a huge value. And I think U.S. investors are looking at non-U.S. and non-U.S. are looking at real estate. So some segments, office needs to come down even further. It needs to readjust to that 5% rate.
Just to square it away very quickly, with bond yields at this level, maybe even touching 5%, are you duty-bound to step in and pick up duration? Are you tempted at these levels?
Not just tempted, we are. We have been feathering into fixed income throughout this year. We're going to continue to. And for us, fixed income, as rates went to 0, we lowered our allocation all the way down to 11%. Now we're in the process of rebounding that back up because we found it attractive.
And do you blend that up with IG? If you're feathering the nest, as you say, then what's your proclivity to investment grade and to high yield?
Well, when you buy the Bloomberg Ag, you buy the entire part of the curve. We like sovereign debt in terms of taking the rate bets and duration bets. And what I'm seeing with ourselves and our peers is investment grade credit is attractive, but you can get a better return and some flexibility out of private credit. And since that's oftentimes variable rate, it improves your convexity and the ability to manage the curve.
Look, bonds to a certain extent over the past 48, 72 hours, at certain moments, behaved in a way which one could say was a hedge, which it was what they traditionally did in moments of real angst on Friday in regards to Iran, Israel. Do we see those hallmarks remain and indeed reassert themselves as a source of a hedge and a haven?
I think we do. As we back away and look at the whole world for opportunities, particularly in those kinds of crisis spikes. And it was interesting. I turned on Bloomberg Radio on Saturday morning, and the only thing that was quoted was gold and Bitcoin, because it's the only thing that trades on the weekend. But what really mattered, those trades were minor. What really mattered was people running into 30-year U.S. bonds. That is still a safe haven. And thank goodness, because we're a debtor nation. We need to borrow a lot of money. So I think that the bond market and the U.S. bond market is still an anchor to say for global investors. It will continue to be. And I think it needs to be part of everybody's portfolio. So many investors are just focused on tech and on public equity. They really need to balance it out with fixed income in their portfolio. And it's got a return, a positive return with a nice steady yield. That's worthwhile grabbing.
We'll take a bit of that and put it in the back pocket. Chris, thank you so much for joining me. That is Chris Ailman, my guest this morning on all things in the markets. So as we look across the IMF conversation that Jonathan just had with the managing director there, which is about the question of the strong dollar. That is the conversation that is happening in Washington. Her call about immigration. It's an unpopular call, but in terms of the benefits from immigration in regards to capping out those wage rises that we are seeing. And if you think that you're going to get a fast and furious cutting narrative from the Federal Reserve, she is very, very doubtful. The Fed may well be stuck in this higher for longer narrative than many had anticipated. In terms of the message that she gave to the PBOC when she caught up with the head of the PBOC last night, it was about stimulate internally, stimulate domestically, and indeed make sure that you right the housing market to a level that gives the middle class confidence to spend within China. Let me get you up to speed with your morning calls in terms of what the analysts are talking about on Wall Street this morning. First up, Deutsche Bank downgrades Tesla to a hold, expecting recent production delays to weigh on quarterly results. Next up, Morgan Stanley. Now, they're double upgrading eBay. They're going to go to overweight on that, citing a boost from artificial intelligence. And finally, JP Morgan upgrades JetBlue to neutral. They say that the company is well positioned to take advantage of improving sentiment. There's one thing that you really got to keep an eye on. These are the equity markets. We're up 0.25%, but it is the call from Vanguard that 10-year government bond yields risks rising to 5%. We've just had a conversation with CalSTRS there saying at these levels in yield, you do want to be picking up some yield. 10-year government bond yield at the bottom of your screen, 4.59. Vanguard's narrative this morning is that on the 10s, a move past 475 could lead to a disorderly sell-off. And if that happens, that's what can take you back to the danger zone. That danger zone is a break of 475. Breaking that danger zone can take you to 5%. We're taking up barely one tick at the moment. But in terms of the narrative for the bond market, we think there's a residual long position left out there. So keep an eye on that. And rolling it across assets, we're counting down to the opening bell right here on Bloomberg. Let's just listen in to Kristalina Georgieva and what she had to say just a few moments ago.
We still remain optimistic that within this year, conditions in the United States would allow the Fed to start cutting. For how fast, I don't think that we should gear up for rapid decline in interest rates.
Can I jump in and ask?
Okay. Let's talk about a couple of the stocks that we're watching here today at the open. First up is Micron. The chip maker is set to get $6.1 billion in grants from the Commerce Department next week. That's according to our Bloomberg reporting. Ed Ludlow has the detail. Ed.
Yeah, let's see how Micron opens, but it's a big number. You're right that $6.1 billion is in grants, and that's important. According to our sources, that figure could be announced as soon as next week. There is a loan component to this as well, where sources say that Micron will accept loans on favorable terms as part of the funds made available by the CHIPS Act, just as Intel and TSMC did. But we don't know what the dollar value of those is. So the total package could be much larger than the $6.1 billion. Micron's got plans, both in Boise, Idaho, its kind of home state and city, and New York State. And what's interesting is that it has 4 locations and projects planned in New York. But regulatory filings recently told us that 2 of them will not be operational until 2041. That's important because Gina Raimondo and the Commerce Department have said that the allocation of funds will be prioritized relative to those projects that can be finished sooner, basically, by the end of this decade. And that would indicate that at least 2 of those New York projects will be on that timeline. And so the entirety of the funds awarded in this tranche will be related to that project. Stock, I've lost track of time, Manus. As you know, I'm a bit of a night owl anyway. We're down 0.9%. Whether the market's open or not, I believe it has now. Thank you. It's an important one. Micron, a big maker of memory chips, a market that is dominated by first Samsung and then SK Hynix, the Korean names. But as you know, if you look at the table in the Bloomberg News story of where funds have already been allocated, those same Asian chip makers are also coming for the US manufacturing footprint.
that the domestic players won as well. So it's interesting. The stock had been significantly higher in pre-market when we broke this news. We're now down almost a percentage point this Thursday at the market open.
Okay, thank you very much. The latest update there on Micron. Let's turn to casinos now. Las Vegas Sands reporting results. It's Macau locations that missed on the estimates. Abby has the detail. Abby.
Well, investors really not liking this, Manus. We have the stock down more than 6%, heading to its worst day in about a year, and you're exactly right. It's not the overall operations, because on the surface level, they really put up a nice beat. They put up 75 cents in adjusted profits. That's 25% better than what the street had been expecting relative to revenues, $2.96 billion, essentially. That is a small beat, but when it comes to Macau, and that is more than 60% of their operations, they really missed the estimates, but it's not just the quarter that was. Looking ahead, some analysts are saying that they have to invest for renovations, so that could weigh on profit, and then just uncertainty in China. What also makes all of this worth noting, Manus, is so many stocks and the stock market itself up over the last year. That is not the case for Las Vegas Sands. So the uncertainty around China has been weighing for a while. Coming into today, down more than 15%. So with this stock down 7%, again, the worst day since May of last year, we now have the shares of Las Vegas over the last year in a bear market.
Abby, thank you very much. Let's turn our attention to airlines. Alaska Air expects second quarter profits to top analyst estimates, signaling that the carrier is recovering from its Boeing crisis. Katie Greifeld has the detail. Katie.
Yeah, we know that the first quarter was a little bit rough for Alaska Air. Of course, we remember that January incident, and then you had federal aviation regulators grounding all 737 MAX 9 aircraft after that incident until the inspections could be completed. Alaska Air did earlier confirm that some travelers had opted to fly on other airlines for a period after that incident. But looking ahead for the current period, they actually raised their forecast for adjusted earnings, saying they will be between $2.20 to $2.40 a share for this quarter, really backed by that surge in travel by tech companies in particular. Analysts had been looking for $2.12, so a big beat there. And then you take a look at their forecast for the full year ahead, and that actually beat expectations as well, or rather they raised it. So EPS for 2024 expected to be between $3.25 to $5.25. The previous range had been $3 and $5. So a raise there, definitely what shareholders wanted to see. You see shares currently up higher by about 1%, had been as high as 4% higher a little bit earlier, but definitely an up day so far for Alaska Air.
Katie, thank you very much. Stock reacting nicely there. Turn our attention to the home builders. D.R. Horton increased sales expectations for its full fiscal year. This is the housing market heads into its key spring selling season. Simone, how does the season look?
Well, on the earnings call just now, executives have been talking about this, and they said they've actually seen the market stabilize and seeing, quote, a very good sales pace in line with our overall plans, even despite the higher rates that we have seen into April. But as you mentioned, Manus, the company able to raise its sales projections for the full year, which ends at September 30th, now seeing building 89 to 91,000 homes and selling them, that was 87 to 90,000 homes. Second quarter results pretty positive here, coming in ahead of analyst expectations with home orders up 14% year on year. Pre-tax margin also higher than expected, and that allowing the company to deliver a beat on its earnings at $3.52. The expectation had been $3.07. Now, again, we're paying attention to the call here. Citi said cancellations were well below expectations, but it wants to know how that plays forward, wants to know more about buyer demand and traffic in April. Jefferies calling this a robust beat, but on the call, it's really going to be focusing on those margins, given the incentives, the buy downs that D.R. Horton has been offering. Shares, though, were higher now, but now up about 2.5%. They had been up their most since December. We'll see where the day closes, Manus.
Okay, Simone, thank you very much. Let's continue the conversation about risk this morning. JP Morgan's Kelsey Barrow and Moneta's Ethan Devitt join me. In terms of the narrative that we're just hearing from the IMF, in terms of the message from the bond market, which my last guest said of CalSTRS is perhaps the most important bell ringing in our ears. We're in a higher for longer narrative. With that in mind, Ethan, let's start with you. This higher for longer stockflation narrative, how do you interpret that?
Well, first, it's a new narrative. We were speaking about Table Mountain and how long it was going to last, but we certainly thought that that table was coming to an end soon, and we were looking at those cuts. So now it seems somewhat exhausting that we've done this round trip in terms of Treasury yields, and we're right back to where we started a few months ago. That, of course, does have implications for stocks. It has implications for the bond market. The 60-40 portfolio won't look too good if the total return of bonds are falling, and it just puts everything in question again. It's like, are we right back to where we are before? What does this mean? How long can these higher rates be supported, be sustained by consumers and corporates? So it does, unfortunately, add to that wall of worry.
Kelsey, how are you feeling about it? Are you exhausted? Are you exhausted? We're sort of back to where we started, as Ethan just said. Do you sense a level of exhaustion here? We haven't quite broken the 475 yet in bonds. Take me through your view on stockflation.
So in terms of exhaustion, we have seen a significant repricing in yields. I look at the one-year rate, and it's over 100 basis points higher. So the market has already efficiently responded to the stronger growth and stronger inflation data. But I think the differentiation between now and, let's just say, October of 2023, where a lot of people are drawing those parallels, is back then, the Fed wasn't done hiking yet. It was still not clear if they would need to go further, and the market was pricing in additional hikes for 2024. Today, we're in a different environment, an environment where there are limits to how far yields can sell off, because ultimately the Fed is deciding between two outcomes, not three. There used to be three choices: hike, stay on hold, or cut. Now there's two choices, which is stay on hold or cut. So these higher yields, what we're hearing from our clients is actually are a great opportunity to get invested at these higher yields and start building a portfolio that has diversification and has income again.
Well, tell me, Ethan, then, I mean, you said the 60-40 portfolio, of course, will have taken a hit just by the virtue of the fact that bonds have underperformed so much. But what is it that would make you take investment grade or sovereign yield? Do you think there is one more leg higher in yield to come in these bond markets? Or do you incrementally add and say, okay, 60-40 will begin to return to normal performance in the back end of the year? You've got geopolitics at play, and you have some people saying you will still get 2 insurance cuts. Some people are saying 6.5% rates. But the thesis, the consensus of the market is at least 2 insurance cuts.
Exactly.
Well,
right now, because we... Oh, sorry.
Ethan.
because we know that inflation is coming down. We know that that makes that real rate of return all that more meaningful. We know how much investors rely on income. They haven't been getting income from the equity market. The concentration in the equity market has made it look a little unsettled. And there is quite a bit of, I think, fear around there. We're seeing volatility pick up and a lot of noise circulate. So I do think fixed income makes sense today. Just like your previous guest, Christopher Ailman, mentioned, it's not just public fixed income. It's private fixed income. It's right along the spectrum. It's playing that exit of banks from the lending segment. Banks are actually doing quite well. We've seen that in the equity side. It's good that finally another segment is starting to come to the fore. So I do think the case for fixed income is there. Technically, because spreads are so tight, I'm not seeing a ton of enthusiasm around pricing where they are today, especially in high yield or investment grade. But I do think that as they're having a role in the portfolio with these levels of yields and inflation coming down, it does make sense.
Kelsey, I'm heartened by the fact that you say there are limits to how much further this sell-off can run.
So we think there are limits to how much further yields can rise because the Fed is still in a mode where they think they've done enough, and the next move is either to stay at these levels or to move lower. So what is causing that conviction for us is ultimately we do think that inflation should be moderating. We need to see it in the data. The Q1 data was a little bit of what we hope to expect to be an outlier, but we do expect inflation to be moderating and growth to be moderating. When you look at Q3, we were running at 5%, and then Q4, we were running at 4%. Now Q1, we're running at 3%. These are great growth numbers. They're a great backdrop for corporate fundamentals, but it is still an environment that's moderating. Ultimately, the Fed is in a good place here.
Do you think, Kelsey, it's wages that moderate more quickly than we presume, Or is it that growth slows down more materially? I was listening to the global head of economics for UBS on surveillance just at the end of the show. He said the sources of growth in the United States of America are narrow. They were fiscally driven in 2023 through the IRA and through the CHIPS Act, and that those fiscal boosters will dissipate. So this slowdown, the confidence that you have, what is that most predicated on?
Yeah, so our confidence is not about growth rolling over or being very negative. It's really just the fact that it's healthy, but it's not necessarily re-accelerating to the point where the Fed needs to re-engage the hiking cycle. So that's really the differentiation. But I will say on the wage front, that's probably the area where we've had the most consistent amount of information that is pointing in the right direction. I turn even to the Beige Book released yesterday. There was a comment in there about, in general, wage gains have basically returned to their historical averages. So we had a period where there was a very intense labor shortage and the employee had the upper hand. That's really just returning to normal. It's not indicating that the labor market is weak, but it's indicating that the labor market is more balanced.
Even if we can close off with a comment from you. I know that you've been looking at the dollar. It's the only thing that anybody's talking about in Washington. It's amazing how the conversation shifts from our markets here in New York to the IMF meetings in Washington, and it is about the dollar strength. And you now have a trifecta of admission that that strength in the dollar is something the US is prepared to allow the Japanese and the South Koreans perhaps to reduce. Your interpretation of the strength in the dollar and Yellen signing on to this press release, which we would say tacitly allows the others to intervene.
It's very interesting right now. We have on the one hand, and again mentioned earlier, the rise of gold and Bitcoin, suggesting a concern around currency debasement and some concern around those rising levels of debt at a country level. And then we also have the US dollar being so strong, the juggernaut of global growth and the penalty that that represents for other countries essentially, and how we now end up with the US continuing to be in the lead. So it is a problem, this strong dollar. We have to remember we're dependent on a global economy. It cannot be sustained forever, and we think that that is going to ultimately show the ongoing weakness of our trade partners. So it is interesting. I probably should not be sustained, but then again, that's the anomaly that we see this concentration in markets continuing to exist and really distort the picture.
Well, I'll leave you with this thought. It was 2019, and that's when the US accused China of being a currency manipulator. Japan and South Korea were on the same list as well. How things have changed. Ethan, thank you very much. Ethan Devitt, Kelsey Barrow on markets this morning. It's all eyes down for Netflix. They're going to kick off another round of big tech earnings.
I think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy.
Let's hope you're not sharing your password. Netflix down just over 1%. We'll dig into what the reports are expected to give us.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
I think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy. Our survey work during the quarter continues to show the absolute stickiness of that premium tier.
Netflix will kick off the big tech earnings after the closing bell today. Analysts are expecting streaming leader to register another strong quarter of growth in subscribers following a crackdown on account sharing. Geeta Raghunathan is from Bloomberg Intelligence. So all eyes down on the subscriber growth. Where will the alpha of growth come from geographically, Geeta?
Yeah, Manas, it's always kind of been more on the international side. So the US is a pretty mature market right now. That said, their new initiatives, both with the ad tier as well as the paid sharing, where they're cracking down on password sharing, has definitely helped kind of reinvigorate US growth. But majority of the growth there going to come from the international markets. Asia Pac and Europe are the big ones there.
And to sustain that, I mean, they've got multiple growth drivers. I'm just curious, how does pricing going to play into this? I mean, I look at my own TV. I think I've got Amazon Prime, I've got Apple TV, I've got my Netflix. I'm a multi-channel. But even I'm nearing the limit of what I want on the television in front of me. I'm not that price sensitive, but tell me about the rest of the market.
Yes, I think what Netflix has managed to do is in many ways, Manas, they have really won the streaming wars, and they have kind of become this de facto option right now for most households across the world. I mean, if you're thinking of entertainment or what do I watch today, I mean, you kind of tend to gravitate towards Netflix, and that's what they can really bank on when it comes to pricing power. So they definitely have the edge relative to their rivals. And if you just kind of think about, the US itself, their standard plan, which costs about $15.50 a month, the last time they raised prices on that was back more than 2 years ago, January of 2022. So obviously we're due for a raise there. And I think what really kind of gives investor comfort in terms of, are they able to raise prices? I think yes, it's a resounding yes, because now they have this lower priced advertising option. So anybody who's very price sensitive, obviously they can control churn because you do have that lower priced option now for $7 a month in the US.
Okay, Geeta, thank you very much. Let's see what the numbers say tonight. And who out there doesn't press yes when it just comes up? The price has risen. Do you want to continue with your subscription? The bond market matters. Listen to it more. That was the message from councillors who were with me just a little bit earlier. Now, yields are popping ever so slightly higher. The US jobless claims come in at 212,000. The estimate was for 215. So a solid jobs market. Another reason for the Fed to obfuscate, to extend and pretend. But I'm drawn to William's comments from the Federal Reserve, where he says rate hike is not the baseline, but possible if the data warrants it. So again, they're trying to reaffirm that rate hikes are not our baseline. But he does go on to give you the counterbalance. So the bid and the offer, which is they will cut rates at some point. The economy will drive the timing. So there's a number of facets in this bond market this morning. Monetary policy is working the way we hoped. Those are the lines coming from Williams. Let's get into the sector price action. Abigail Doolittle is with me side by side.
So it's another interesting day early on, Manus, because we have already had stocks start higher and then go lower. Right now, up ever so slightly, a pretty even split. Actually, we've had a number of sectors just over the last couple of moments go ever so slightly higher. The best sector on the day, though, communication services, up about 0.6%. Financials, industrials, also higher to the downside. Tech and discretionary utilities. No big moves, though, right now. Investors are trying to figure out what's what. Where we do know what are the chips. We have the stocks down 1.2% over the last 4 days or this week. I believe that's what we're going to see here, down nearly 5% on the month, heading to more than 8% decline, the worst in many, many months. And of course, there's fears for NVIDIA, too far, too fast. I'd also point out yesterday the possibility of tariffs by the U.S. Against China on aluminum and steel. Well, of course, the poster boy for tensions between the U.S. and China, that's chips. So I think that there's some tension hitting the chip sector on that possibility as well, Manus.
Yeah, well, NVIDIA down 4% on the week. It's got a small bounce in it this morning, Abigail. You're right. Those chips are a real focus for us at the moment. Coming up in the show, we'll give you the market moving events to set your clock by right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Markets are struggling for a really clear direction at the moment, as you can see. NVIDIA's up by 0.5%, S&P barely holding on to its 5,000 level. Let's see how that plays out through the rest of the day. We're going to get those Netflix numbers later in the day. That can help define perhaps where some of the big tech sentiment goes. Now, in terms of the rest of the agenda, it's a matter of moments before we get the existing home sales for the month of March. As I said, Netflix will come in after the bell. And then tomorrow, India's general elections begin, and we get the earnings from American Express. That was countdown to the open. We've been off to the IMF meetings in Washington. A very clear message from the managing director there, which is about China. Rebalance China. Boost your domestic spending. and in terms of the angst over the strong dollar. Well, let's just see what happens next. But that is as much a political statement from Janet Yellen as it is about a financial statement in terms of the strength of the dollar and what the Japanese and the South Koreans can do. We're struggling for clear direction in equities. We'll get a little bit more clarity as the day rolls on, right here on Bloomberg. Good morning.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
DOJ or other authorities
could face bigger challenges.
Next. Fed was going to keep rating World Cup.
This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast. Coming up, we're going to get the latest read of the housing market. We do that with Drew Redding, Bloomberg Intelligence, U.S. home building analyst. And then George Ferguson's going to check in with us. He's a Bloomberg Intelligence senior aerospace and airlines analyst. Talk to us about what's happening over there at Alaska Airlines, as well as an update from Boeing. Then Mark Douglas, president and CEO of Mountain, is going to join us. We're going to preview some Netflix earnings, which we're going to get after the close. Netflix, that stock is up 25% year to date. So that whole cracking down on file sharing seems to be working. Right now, let's kick everything off with Lisa Mateo and a Bloomberg Business Flash. Lisa.
You got it. And Market Driver is brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, we've got red and green on the screen, and this is after Wall Street extended what is now the S&P 500's longest streak of losses since the beginning of the year. Right now, we have the NASDAQ lower, down 0.2%. The Dow up 0.5%. The S&P 500 is little changed. Now, we also had declines come yesterday. This is after the Fed's Loretta Mester said policymakers can hold rates steady. Yesterday, we also saw the summary of the Fed's beige book. Today, though, it's about jobless claims. There wasn't much to it. No change in the labor market for the latest round. 212,000 applications were filed. We also had the Philadelphia Fed's Business Outlook Index, and that came in stronger than expected this month at 15.5. As far as yields, we had the 2-year yield at 4.97%, and that is up 4 basis points. And then we have the 10-year yield at 4.62%, and that is up about 3 basis points. Checking in with commodities, we have spot gold. That's higher at $2,378 an ounce. And we have NYMEX crude at $82 a barrel, Brent crude at $87 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so very much. I'm Alex Deal alongside Paul Sweeney. We are planning my vacation, going to DR. Yeah, so we're working on like sunset cruises, snorkeling.
Always fun.
Yeah, so we're going to discuss that throughout the next couple hours. We did have some data coming out. We had housing data, but also we had the Conference Board U.S. Leading Index. I'm not 100% sure I know what that even is. It was down by about 0.3%. That was worse than estimated. The prior month was revised up to 0.2%. So that feels like that's a really big dip. Luckily, we have Dana Peterson. She joins us now from the Conference Board. This is her data. She can talk us through it. Dana, what is this? How do I read this information?
Sure, absolutely. So the U.S. Leading Economic Indicator is a measure that's been out for a long time, and lots of people look at it and see it as a gauge for where the economy is going, whether there's a recession that's going to happen over the next 6 to 12 months or not. And basically, this measure did dip in the month. And when we looked at what was actually good, it was very little, just the leading credit index and also the stock index. Everything else was either negative or flat. And indeed, when we look at this gauge over the long run, it has signaled recession. But the thing is that it's signaling weakness in some parts of the U.S. economy, but it doesn't capture all parts.
All right, so talk to us about what we're seeing here. Again, the leading index came in at negative 0.3% today. Consensus was a negative 0.1, so weaker than expected. What's driving it?
Sure. Well, things that were down in the month were jobless claims. This is for March, not for April. So jobless claims were down. Consumers' expectations for business conditions was down. Also, the yield curve was more negative. So you had a lot of things that just weren't really working well. And also permits weren't doing well. And certainly we know that the housing sector remains weak as mortgage rates have actually ticked back up and are quite high relative to what people experienced during the pandemic. And of course, that's because the Fed has raised interest rates and is keeping them pretty elevated for some time.
Dana, before I let you go, can you overlay a 5% 2-year and a talk of a 5% 10-year onto this kind of data?
Well, the thing is that we know that the 2-year yield is probably, it's reflecting what's going on more so in the Fed funds rate. Meanwhile, you still have an outsized balance sheet and uncertainty kind of weighing on the 10-year. And so that's why the yield curve is still negative. And for some folks, that signals recession, but it's not the only measure. And certainly we don't think a recession is going to happen in the U.S., but certainly we could see some moderation in growth as consumers kind of pull back after spending tons of money and piling up a lot of debt. But we don't think that the labor market's going to crash. It's probably still going to do well. And the Fed is still going to be looking at inflation gauges to see, can they get back to 2% and can the Fed start cutting interest rates this year?
All right, Dana Peterson, thank you so much for joining us. Dana Peterson, chief economist at the Conference Board, breaking down some of the data coming out of the board. The leading economic indicator came in a little bit weaker than expected today. Looking at the markets, got some red and green on the screen. We've got the S&P pretty much unchanged. The Dow up about 0.5%, but the NASDAQ off just fractionally. Let's bring in Abigail Doolittle. She follows these markets for Bloomberg. Abigail, what do you see in some of this early trading today?
Well, yesterday you and Alex were saying that not a lot was going on, and today I would agree with that assessment. Not a lot is going on right now, although I would point out we are right now potentially going to see another bearish reversal. We've had 3 days in a row into today where stocks started higher and then ended lower. The S&P 500 has dipped lower. Right now it's slightly higher. The NASDAQ 100, however, started higher and now is down by about 0.1%. But these moves are really too small to bake all that much into it and to know what will play out. Something that does stand out to me, though, the SOX down 1.2% this week, down more than down almost about 5%, and then on the month down, I think closer to 8 to 9%, the worst month in quite some time. And of course, Nvidia, a piece of that. And too far, too fast. But I would also say yesterday, President Biden talking about the possibility of tariffs against China on aluminum and steel. If that sort of tension increases, chips, that's really the poster boy there. So kind of offsetting some of the good news around some of the money for the U.S. CHIPS Act finally being allocated.
I also want to point out to Liam Denning's column, he's a Bloomberg opinion, and he talked about the relationship of trade, China, and climate, and how every kind of legislation is getting wrapped into this, and that the free trade world is toast. Anyway, it was really great. You guys should definitely check it out. What I also found interesting, I also agree. I was like, this is boring. But then William spoke, and he used the H word. He said a hike is not the base case, but you can do it if it's needed. We also had Vanguard saying that we're in the danger zone. Did you see this? For the 10-year yield, 4.75%, and then you get a spike to 5. Abigail, what kind of risk are we looking at for the market on that?
I think that we very do likely see the 10-year yield go back to 5%, which means the 2-year yield, which it has already been there over the last couple of days, could go back to its old 5.26. I think that was the high level not so long ago. And I think that what it represents to stocks is, a tightening of liquidity that had not been expected at the beginning of the year or at the end of the year. Certainly not a piece of the calculus in the rally from October until the recent highs. And I think that that's why we have stocks down in recent weeks, and that we could, in fact, just see a continuation of that. The interesting piece is going to be earnings. So earnings could come in good for big tech, but against that backdrop of liquidity certainly not being put back into the market, and depending on how high rates go. Let's remember Jamie Dimon, who's been pretty good on this. His numbers are always much higher, but his direction has been correct. So I think he initially was calling for 6, 7, and now 8%. That could be painful for stocks, the economy, the real world, for sure.
Jonathan Farrow is famous for just ignoring the Dow Jones Industrials, and I can kind of see why. I mean, it's up 165 points, 0.5% today, when the rest of the market's doing nothing, and I wonder why. It's because United Health Group has the biggest weighting in it, like bigger than Microsoft. Who's in charge of that?
Well, that's interesting, really.
Yeah, it's got an 8.6% weight. I mean, Microsoft's at 7%. It kind of just goes to the issue of, is the Dow Jones Industrials just irrelevant now? As much as I love the Dow 30.
Yeah, that's a pain point, because I like the transportation index on the Dow, right? It's like as goes transports, goes the Dow. Right. But if we don't care about the Dow, do we care about Dow transports? Because that would really wreck me.
Right. I think you have to go with Dow transports, but it's just odd on an odd day.
I don't not care about the Dow. I mean, I think the S&P, it's a different index than the other ones in the fact that I think that it's like just a quick snapshot on the U.S. The biggest companies that are, it's interesting in terms of what's been kicked out and put in more recently. Now the idea that you have Microsoft CRM, a lot of these tech companies in there, I think it really is a quick snapshot. The S&P 500, I would say, is a better snapshot because it's broader.
Yep.
Then you go Russell 2000 for small cap. So I like the Dow. I understand what we're saying about the weighting, but I also really love the S&P 500 equal weighted index. Gives us a good snapshot without
That's
tech.
a good one. Yeah, that's true.
SPW. Abigail Doolittle, thank you so much. We appreciate that. As always, Abigail breaking down the markets for us. Again, the S&P up about 0.2%. Let's go over to the housing market here. Drew Redding joins us. This is his job. We hired him to be like the housing analyst. We had a housing analyst like the very early first days of Bloomberg. He's not very good. So we had to upgrade. So we got Drew Redding. We brought Drew in, and he's been a great home builders analyst. Drew, thanks so much for joining us here. Give us kind of a snapshot of what you're seeing out there in the U.S. housing market.
Sure. So the U.S. housing market continues to be a tale of two markets. We had some data on the existing home sales front this morning. We saw sales which were roughly in line with expectations at about 4.19 million on an annualized basis. Keep in mind, we're still down about 35% from the peak back in 2021. So this is a market that is still extremely depressed. The other thing you have to remember with the numbers we saw today is that they represent closings. So these were contracts that were signed, 38 to 60 days ago when rates were more in the 6.5% to 7% range. So we think that going forward, you're going to continue to see a little bit of weakness on the existing home side of things.
On existing homes, are we seeing it a buyer's market or a seller's market? Basically, are the sellers willing to finally come down in price?
Well, surprisingly, we haven't seen all that many price corrections. We're still seeing median prices rise. You're actually seeing prices in the new home market come down a little bit because builders are adjusting square footage. And they're also, trying to meet the market in order to move their inventory, but not so much on the existing home front. And, at the same time, one of the key stories on the existing side has been that there's just not a lot of inventory out there in the market. We are starting to see that flip a little bit more recently, so that'll be something to watch. If we start to get a lot of inventory coming to the market, you could see more price adjustments from sellers.
But I guess the reality is, Drew, I mean, everybody thinks they're an expert on the home building business, so it must be frustrating for you because you actually are an expert. But I mean, the reality is, house comes on the market, boom, it sells in like 15 minutes. I mean, because there's nothing out there, and it doesn't really matter where the mortgage market is, it seems like. But, is that in fact the case, what you're seeing across the country, or is it regional?
Yeah, it's a good question. I mean, the market is regional. We had, when we started to come out of the initial interest rate spike in the back half of 22, we saw that markets in the East, which didn't rise as much during the boom time, were a little bit more stable. And markets on the West Coast, California, Washington, the Southwest, were comparatively harder hit. What we've seen now is that the increase in demand has started to be more broad-based as buyers have kind of started to get more accustomed to higher rates. I think, to some extent, if you need to move, there's not a whole lot you could do. You start to, fine tune, maybe what you can afford, but at the same time, if you have to move, you're going to find a way to make it work. Now, it's interesting that you said, despite high rates, homes are flying off the shelves. We had earnings results this morning from D.R. Horton, and they actually said that despite the high rates, they're still seeing a pretty solid demand environment in early spring, which is encouraging.
What do you mean? I'm not a home building expert because I look at Zillow and Street Easy all the time in Brooklyn?
Exactly.
Okay, that's just rude. That's just rude, Paul. Hey, Drew, I'm glad you brought up D.R. Horton because you also mentioned concessions that we've been seeing with some of the new homes. What did D.R. Horton say about that?
Yeah, so their commentary was pretty much in line with what it was last quarter, and that's that sales incentives are going to remain at elevated levels over the near term. And you have to keep in mind, when they started this quarter back in January, rates were 6.5. We're almost 7.5 now. So their goal, and builders as a whole, are generally trying to maintain a spread in mortgage rates versus what you see out there as a headline. So if we're looking at 7.5, they're trying to offer their buyers something 100 to 150 basis points below what you would get in the resale market. So they do expect rates to remain elevated. That was one of the main things coming into the quarter, is how would these elevated rates impact the use of incentives and ultimately their gross margins. And encouragingly, their gross margins looking out into the third quarter were only a touch below what consensus was looking for. And I think the fact that the bar has been lowered, I mean, if you look at what the stocks have done over the last month, the bar was lowered coming into the print. So I think investors were comfortable with the commentary they heard today.
Drew, I have a super dumb question, but if the housing market is still so tight and there is so much demand, why do they need to offer incentives?
Well, there's not a lot of inventory in the resale market, and they're trying to make their product more attractive. So part of the business of a home builder is that you need to turn your inventory over to make your business work. So they're seeing a lot of demand for spec homes. They want to move those spec homes because the longer they sit in inventory, the more likely they are to come down in price or come down even more significantly in margin. Just because there is demand out there, it doesn't mean that affordability is not bad. Affordability is still at some of the worst levels in history, and a lot of buyers are struggling out there, and they need these incentives to kind of get buyers through the door and make the math work for them.
Any markets showing signs of kind of peaking? And I'm thinking of the Miamis of the world, the Austins of the world. Have those markets peaked?
Yeah, those are two good names that you point out. Florida has been one of the strongest markets, but interestingly, what we're starting to see now is that inventory particularly in some of those southwestern and western markets like Tampa, all down the coast, we're starting to see pretty significant increases in inventories. Now, by and large, across the U.S., inventories for the most part are still below where they were in 2019. But I think, as a builder, that's really been your advantage. So every time inventories increase 5-10%, you're starting to lose a little bit of that advantage. So one of the main places we're seeing it is Florida. We're also seeing it in Austin, as you mentioned. And, what's interesting with the Florida market is it's an area where you've had a lot of single-family housing converted to short-term rentals. So you're starting to see maybe some of those come back to the market. But you're also seeing a market that's suffering from high insurance costs with, the storms and things like that. HOA fees are going up. So it's becoming a more unaffordable market.
Yeah, I mean, I don't know. It just seems like some of those markets have to peak, if not now. And we're going to go down in June. We're going to go down to another hot market in Nashville, Tennessee. Yes. So Alex and I will do some on-the-ground reporting.
Then we'll
on
be
the
real
local,
home builder analysts.
Yes, exactly. How hard can it be? And you just predict where interest rates are going.
That's what I'm saying.
Drew Redding, he is our top-notch home building analyst at Bloomberg Intelligence. Again, a significant upgrade from the first guy we had in there. So very good for Drew Redding there. Talking about the housing market again. DR Horton had some good numbers out this morning. That stock is up 3% today. Just looking at the market here at S&P 500, kind of getting a little bit of a bid here, up 0.25%, 13 points. The Dow up 0.6%, 245 points on the Dow, and the Nasdaq up about 0.1%. Yields slightly higher here. The 10 years 4.62%. We'll call out WTI crude oil for Alex. It's up just fractionally, just under $83 a barrel for WTI crude oil. Bitcoin finds a bid out there, up 4.7%, 63,700 on Bitcoin. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are advancing after yesterday's sell-off. Right now, the Dow up 0.5%, the S&P 500 up 0.2%. The Nasdaq right now is little changed. Over to the two-year yield at 4.98%, up 4 basis points. The 10-year yield at 4.62%, up 3 basis points. To commodities, we have spot gold higher at $2,380 an ounce, and over to oil, Brent crude at $87 a barrel. We have the dollar stronger, Japanese yen, euro, British pound weaker. Bitcoin up 4% at 63,773. Want to take you over to the tech sector. We'll start with Micron Technology. Right now, they're up 0.5%. Sources saying it's getting a $6.1 billion. That's from the CHIPS Act grants next week to help pay for domestic factory projects. And then you have Infosys. Their ADRs down nearly 2%. They reported net income for the fourth quarter that beat estimates. That is your Bloomberg Business Flash. Paul and Alex.
All right, very good, Lisa Mateo. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Let's talk a little airlines here. Alaska Airlines, they had some good earnings. Stock is up 4% today. For the longest time, until just recently, when I looked at an Alaska Airlines plane and the tail fin, they have the image of an individual. You know who I thought that was until just recently? Jerry Garcia.
Who is it?
Well,
I don't even know what you're talking about.
Okay, so Alaska Airlines on the tail fin, go Google it. There's an image of an Eskimo. Up until just recently, I thought that was Jerry Garcia. And I was sitting in a Seattle airport talking to a pilot from Alaska Airlines. I said, boy, you guys are so cool. You have image of Jerry Garcia on every plane. He says, no, numbnuts. It's not Jerry Garcia. It's an Eskimo. We're Alaska Airlines. How stupid can you be? So that's, my bubble was popped. George Ferguson, he covers all the airlines, the aerospace companies. So I guess, George, we look at Alaska Airlines, the Jerry Garcia airline. What's happening there? They had some good numbers.
Yeah, so pretty nice, very nice numbers, actually. Pretty surprised. It's all about strength in revenue. Right now, the surprises we're seeing, like United and Alaska, if your revenue line, has come in better than expected, yields are doing better at these airlines than, again, we expected going in, then you're getting a nice beat on earnings. And Alaska cited return of corporate travel, continued strong leisure trends, and we were kind of looking for a slightly down yield number, and they had definitely with the adjustment for the panel blowout from Boeing, they would have had 5% unit revenue increase. So very strong, very impressive.
So I'm confused. I thought that the business airlines were like United and American and Delta, not Alaska Air.
So Alaska does have premium, premium seats in the front of the airplane. So they are a business airline. I don't see them as sort of a big corporate airline because they're pretty regional, right? They're very West Coast focused, very Alaska focused, as it seems like Paul's become more aware of recently. Then they do a bit of transcon right into the East Coast. You got to be able to provide your customer service into the other important population center of the U.S. But they lack a lot of, I would say, the middle of the country routes, and they don't have any international. They partner up, or they have a little bit of international. They go into Mexico and some of those leisure markets, but they partner up with other airlines to provide that international. And it's hard to be a big business airline if you can't get your customers all the way around the world. So that kind of keeps them to smaller businesses.
Hey, George, John Tucker was just telling me that gasoline prices to fill up his Hummer, they're up almost 70% off of those lows.
$3.50 at the Wawa.
Exactly. How about jet fuel prices? Is that an issue for the airlines here?
It is. It's going to be an issue in 2Q. So in 1Q, it was a tailwind compared to the 1Q last year. But if it stays on this trajectory, or just stays at these levels, it's going to be a bit of a headwind. Question will be, if demand is so strong, I'd expect the airlines to be able to push it through in pricing to the customers, and we're going to see that. I think the other big question here too is, we're kind of into earnings season. We've seen Delta, we've seen United, we've seen Alaska. We've seen airlines with, again, premium product in the front of the airplane. We still have to see the low-cost carriers come through, because I'm not convinced that this strength is in the back of the airplane. But we're going to see, right? As we start to see the real sort of low-cost leisure carriers report, then we're going to know how broad-based this strength is.
I mean, having it be bifurcated would make sense because that's what we're seeing in the broader economy, right? One part of the economy is doing well, and the other just is not. Delinquencies are rising for credit cards. You're seeing more money being spent on credit cards, et cetera. We heard that from banks in terms of charge-offs. So if that were the case, where are we in terms of valuation for, say, the front of the plane, back of the plane carriers?
Well, I mean, first of all, airlines are always sort of valued lowly, right? They're not there. If you go for a PE multiple, you're in the mid-single digits. So I mean, airlines are kind of perennially a pretty cheap stock. But I mean, what we saw with United the other day, that big jump, part of that is them starting to close that gap with Delta, which is an upper single digits, PE valued airline. But again, they're always kind of cheap because when things go bump in the night, airlines have a hard time with demand, right? If we had a geopolitical problem like the war really raged up in the Middle East, you'd probably start to see less demand going internationally. All of a sudden, you can't fill airplanes. A lot of operating leverage in this business, and so when that demand falls off hard, it really hurts.
All right, George, on the YouTube feed, I can see that you are in yet again another hotel room, which reminds me you're at another boondoggle that we are financing here. You're at the corporate, I guess, aircraft kind of thing out there in Arizona. If I want to go out there and get the latest Gulfstream, I don't know, 6, what's that going to set me back? Is it competition out there? How is that market?
So the latest is going to be the 700 and the 800. Nice. And you're going to be up in the 70 millions range to own one of those. They're they're very long range. The 75 million US, yes. What we're hearing out here from these folks is, look, private aviation was very, very strong in the pandemic, right? As the very well-heeled, some of them were flying in the front of the airplane for Delta and United. They moved to private aviation. And what we're starting to see is some of those, those people that were flying private, unfortunately, they're moving back to the airlines. And that's part of the trend that those poor folks have to get back on a tube with the rest of us other people in the world. So that's part of the trend, too, that's helping the airlines, especially in the premium seats. They're seeing a little bit of an ebbing of demand of some of those high-end travelers. But this business is still pretty strong. Backlogs are 2 years for most of the manufacturers, better than they've been in a long time. Pricing was pretty good in the pandemic. It's softening a little bit, so maybe you're getting that Gulfstream now for, I don't know, 72.
Hey, now.
See, I mean, here
Paul's gotten excited.
On Bloomberg Television, they're putting up there on our YouTube feed. Isn't that Jerry Garcia? If you look at Alaska Airlines, I mean,
it's
gotta be.
No, we don't call them Eskimos; they're Inuits.
Inuit, yeah.
All right.
Paul's still focused on that.
Yeah, exactly.
I just feel bad.
Maybe
for those
Jerry
people
Garcia was an Inuit.
Could have been. Who knows?
I just feel bad that those people who fly private now have to come back.
I
mean, that's a tough stuff. That's a tough re-rating on that. George, I couldn't help but notice that your backdrop is the same as yesterday's, which means you've clearly been working really hard in and out of that hotel room. What else are people talking about right now?
Well, I mean, there's always talk in the marketplace about Boeing, right? We've had this whistleblower go through D.C. I'm not sure, what we're learning there yet, but we're still kind of waiting on the Boeing report on how they're going to stabilize their manufacturing. So that's one of the things we're talking about. Everybody in the industry is talking about supply chain. These folks are talking about supply chain here too as well. Supply chain's still at a deficit for workers. That means that, in the aerospace business, there's aspirations for a number of build increases every year. Those aspirations are always harder to achieve given these supply chain labor problems. And there's inflation, right? So again, the very well-heeled are finding out that pilots cost more because the airlines paid them more. So now for the private jet, they got to pay pilots more. So pity them as well there. The front of their airplanes costing them some. Fuel prices are rising. Interest rates are higher. A lot of these people don't finance airplanes, but some of them do.
Yep.
That affects demand a little bit. Same sort of problems we're seeing throughout commercial aerospace.
All right, George, if you know all this stuff, if you were to go out, money and no object, and you were going to buy a private jet for yourself, what would you get?
Wow. I think I would be one of those Gulfstream 700, 800 folks, right? Because that aircraft will take you across the Pacific without a stop, and so the world is kind of truly your oyster at that point.
So are you asking for a friend or?
Asking for a friend, yeah. I don't know. I mean, it's interesting. I mean, there's a lot out there.
I'll stick with the Falcon jet.
You like the Falcon?
Yeah, if you go up to Teterboro in New Jersey, the corporate airport there, that's where many Falcon jets are.
Well, we go.
And it's Taylor Swift's jet too.
Is that what T Swift
now
flies?
you got my
attention. Oh, now you got your attention. T
Yeah.
Swift is flying that, but you can go out to Marshtown as well. I hear some private jets out there as well. So
I flew on one once, like
Yeah?
20 years ago.
All right,
It
here's
was cool.
We'll let George go. George Ferguson covers all the airlines and aerospace for Bloomberg Intelligence. Back in the day on Wall Street, it was so crazy that these aircraft companies were giving us aircraft to try out and just take on road shows, giving it to us for a week. And we're like, sure, thank you. Just
Does
to try
anyone
to.
kind of want to be Paul, like sometimes in a past
I
life?
tell you, the 90s, particularly the early, it's just
And now he's here with us.
I mean,
how the mighty have fallen.
I mean, we would get a plane. Hey, Paul, do you need a plane for a week? I call up on my companies and we'd go out and see clients for a week in Europe or on the West Coast.
Okay.
Crazy
Sign
times.
me up.
So that's why I was asking George. I mean, if you're going to go out and buy one, what would it be?
Yeah.
I guess it would be a Gulfstream.
Oh, George. All right, you go buy that plane. You can let us borrow it. All right, coming up, we're going to talk about Netflix reporting after the closing bell. Mark Douglas, president and CEO of Mountain, will be joining us for a preview. What about the password sharing crackdown? This is Bloomberg.
World and national news in New York City. Here's Mr. John Tucker.
And it's day 3 of former President Donald Trump's criminal trial in Lower Manhattan. And only 15 minutes in, they already dismissed a jury member, Judge Merchan, excusing juror number 2, after she said she had thought it over and decided she couldn't be fair. She said she had gotten messages from friends, family, and colleagues on her phone. The Biden administration has imposed fresh sanctions on Iran over its April 13th strike at Israel, targeting a company that made the engine type used in drones launched in the barrage. Treasury Secretary Janet Yellen said in a statement, they're using Treasury's economic tools to degrade and disrupt key aspects of Iran's malign activity. Republicans have upheld the Arizona abortion ban. Let's get an update from Bloomberg's Steve Potisk.
Republicans in the Arizona State House blocked 2 attempts Wednesday to repeal the state's 160-year-old near-total ban on abortion, despite pressure on the GOP, including from former President Donald Trump, to change course on the hot-button issue. But later in the day, 2 Senate Republicans joined with Democrats enough to create a majority to move forward with their version of a repeal. A final vote on the bill could be weeks away. If the Senate does ultimately vote to repeal the ban, the measure would go back to the House, where it would still face a difficult path. Steve Potisk, Bloomberg Radio.
And President Biden will be endorsed today by more than a dozen members of the Kennedy family at an event in Philadelphia as he looks to blunt the outsider presidential bid of Robert F. Kennedy Jr. And crime and punishment may be on the ballot in California Election Day. A coalition seeking to revamp California's landmark criminal justice law says it's collected enough signatures to qualify for November's ballot. The proposed homeless, drug addiction, theft reduction act seeks to roll back parts of Proposition 47, a law passed in 2014 that reduced punishments for some lower-level crimes. Global news 24 hours a day, whenever you want it with Bloomberg News.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are advancing after receiving some more economic data this morning. No change in the labor market for the latest round of weekly jobless claims. 212,000 applications, they were filed last week. Continuing claims, those were also little change. We had the Philadelphia Fed's Business Outlook Index. That came in stronger than expected this month at 15.5. And then on the housing front, sales of previously owned homes in the U.S., they fell in March from a one-year high as rates kept those buyers sidelined. Well, speaking of housing, we want to get to earnings from D.R. Horton. It increased sales expectations for its full fiscal year. Right now, those shares are up more than 3%. We're also expecting earnings later today from Netflix. Their shares up nearly 1% right now. Bloomberg Intelligence says subscriber growth could blow past estimates. I mean, the shares have been on a roll the past 6 months, adding $112 billion in value. And that's thanks in part to that password crackdown and also that new ad-supported subscription tier. Over to the markets, we have the NASDAQ up 0.2%, the Dow up 0.6%, the S&P 500 up 0.3%, the two-year yield at 4.98%, up 5 basis points, the 10-year yield at 4.63%, and that's up 4 basis points. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you very much. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all the top analysis from our top analysts that we have at Bloomberg Intelligence. They cover 2,000 companies in 130 industries around the world. We're back live in our Interactive Broker Studio right here at Bloomberg headquarters in Midtown Manhattan. And Lisa was just talking about Netflix and password crackdown sharing and all that. They're also doing the sports thing, right? Are they doing any gambling stuff or no?
No, I don't think so.
Maybe video games. Maybe they'll do the video games. So there's opportunities here. So we wanted to get more with Mark Douglas, President and CEO of Mountain, to get a perspective of what to look at. Mark, what are you looking at when Netflix reports today?
Well, I think everyone's expecting it to be great news because Netflix gave great guidance. So the near term looks like it's going to be spectacular. I think they'll probably, really beat on earnings. The thing about Netflix right now, virtually all their growth is flowing directly to the bottom line. So this is where it used to be a company that never made money. Now it's a company that's just spitting off profits. And I think that's going to actually start to take over as like the key thing investors look at rather than just looking at subscriber growth.
So Mark, talk to us about some of these revenue drivers that I know the street's been talking about for the last couple of years, one of which is password sharing, cracking down on that. The other one is the ad-supported aspect of the business. To what extent are those two issues contributing?
Well, I think the password sharing, clearly it's easy, is highly leveraged. You just get a few engineers in a room and they just make it harder to share passwords, and it creates huge amount of growth. And I think Netflix always knew they had that in their back pocket. The part about it where they're doing, kind of discounted memberships in order, and you get ads with them, that part is working well in terms of selling the discounts. I think in terms of selling the ads, it's going a lot slower for them, but they do have a ton of upside there. So I think, again, that is, I think, where you should be looking to future growth is how do they actually monetize those ads as opposed to just looking at subscriber numbers.
Here's my question. What is already priced in? Like you mentioned, they guided it to be good. So are we in like a buy the rumor, sell the news kind of thing at this point, which is unusual for what we would think is like a Mag 7 company, even though it's not technically in the Mag 7?
Yeah, I'm not sure it would sell the news, but I certainly wouldn't expect the password sharing to be, it's not an endless number of people that were sharing passwords. At some point, that's going to start to tail off. And so what kind of has to happen is the ad revenue has to come on strong at some point. Right now, it's pretty weak. I think people see numbers and they're over 1 billion. But, given the number of people watch Netflix, it's not actually a huge number. So it's a lot of upside, but there's a lot of execution for them still to do. So if I were, actually, I was going to say if I were holding stock, I do actually hold Netflix stock. I've done very well on it the last few years, and I would continue to hold the stock. I think it still has a way to go in terms of growth.
Hey, Mark, I'm just looking at the financials here, and for calendar year 24, the street's got almost $40 billion of revenue, EBITDA margins 26%, free cash flow $6.3 billion. That is a good good business model. How about the rest of the streamers out there? How about the rest of them? I mean, how many streamers can have a similar type of performance in the streaming business? Because you look at the stocks of the traditional media companies, other than Disney, it's a disaster out there.
Yeah, so, you know, there's two things at work here. One is you have to reach a break-even point, which Netflix has clearly done, where, you know, kind of the cost of the content and the number of users, you know, kind of really line up. And then every incremental user is incremental profit and incremental cash flow. And so for Netflix, they're there. I mean, we're talking over $250 million worldwide. And by the way, I mean, why can't that be $500 million worldwide? So you know, they're there. And for everyone else, they're just not quite there yet. I mean, they struggle to keep their subscribers. Netflix, I've always said, is like when you turn on your TV, it's the first place you go. It's like the new cable guide. Let me go see what's on Netflix rather than let me just see, you know, what's scrolling on the cable guides and what's something to watch. And they can't lose them, and people just won't let go of that. Mm-hmm. And so I think the other folks, what's going to happen is going to be a lot of consolidation. If you don't know why you would go to see, like if you go to Netflix because they have everything, go to Disney because they have children's entertainment, you go to ESPN because of sports, why do you go to CBS? Like, nobody can name that. And if you can't name it, it's not going to exist. It's going to be consolidated and just essentially bought for as a library to fill Netflix essentially and maybe Disney.
Wait, do you really have a TV Guide subscription, Tucker?
No, I don't. But I will tell you this.
When did you discontinue it?
I was cleaning out the attic and I found my TiVo, and it's just like, I don't know what to do with it. I don't want to throw it out, but I guess I have to.
I think you're going to throw it out.
Yeah.
Yeah, I just made my mom throw out all her VHS tapes.
If anybody wants a free TiVo, it's in the back
Call
of my
John
car.
Tucker. Here's my very silly question, Mark, is that who is actually a true competitor to Netflix? We can name a bunch of the streamers, right? But they have so many other business models too. Like if I'm an advertiser and you're pitching me, why would I go anywhere but Netflix?
Well, I think the consolidation that you kind of start to see happening with, you know, Paramount being on the block, I think what you have to do is you have to build a big library and and have a lot of original content. And the ability to match that exists, but you have to piece together the right assets. Like you need HBO combined with buying, you know, everything from CBS and ABC that they have in their old library. And like you kind of have to piece that together. So the question is, who has the ambition to do it? At the moment, no one, but I don't think that'll last forever. I think someone will step up to the plate. They're going to have to do it with a lot of money, though.
All right, Mark, let's step away and take a look at TV advertising in general. Does any advertiser of merit even go on broadcast and cable television anymore, or is it just the healthcare advertisers selling me some drug for some ailment I didn't even know existed?
Well, you know, the linear TV, it's broadcast. I think a lot of advertisers, the industry is split. Let me say it another way. The industry is split into two sections. So on one, you have reach and frequency. That's why people like the Final Four, the NBA Finals, you know, the NFL and stuff like that. And you just want to reach a big audience at once. The Olympics, and that still plays a role. And there are, you know, 25% of this market is not going to let go of cable anytime soon, at least. And so if you're an advertiser and that reach and frequency is your goal, that's still attractive. I think for everyone else, you know, they want to do digital advertising, targeted, measured, things like that. That's what my company does, Mountain. You know, we have more advertising customers than Netflix. You know, and so, you know, that's what everyone else wants. And there's room for both of them, but clearly you can't sustain a TV network just on linear anymore. And that's, you know, that's why Paramount is on the block, and because they can't get the viewers on streaming that they need to.
All right, great stuff. Really appreciate it, Mark. Thank you very much. Mark Douglas, President and CEO of Mountain. Just looking at the stock here, doing some quick math. We look to the October low, and Netflix is up 78%.
Yeah, just amazing. I mean, the volatility in that stock, and the volatility of the stock around earnings is always a good one. So
That's
usually like a plus or minus 8-9% when they release earnings. It's a big volatility. It's a little bit less so because it's become, as Mark was saying, a little bit less of a subscriber story, maybe a little bit more of a profit story.
All right, well, coming up, we're going to talk about how Ozempic is now creating oops babies.
What?
Paul doesn't know about this. It's going to be really fun. If you lose some weight, you have babies and you weren't expecting it.
Oh.
I mean, something to talk about. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Taiwan Semiconductor delivered a better-than-expected revenue outlook and reaffirmed its spending plans for this year. Dan Ives at Wedbush Securities says it's a strong setup for tech earnings season.
You're going to see chips, AI revolution, enterprise, consumer on the digital side, I think Google, Meta, and others. I think this is really going to be a flex the muscles moment for tech. So my view is, no doubt, white knuckles, many yelling fire in a crowd theater on tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity rather than the time that was something more structural.
All right, and those shares right now, they are down 3%, but the company, that's why it scaled back its outlook for a chip market expansion, warning that the smartphone and PC markets remain weak, and that's why shares are lower. We have more layoffs at Rivian. The EV maker will cut another 1% of its workforce. That's the second round of layoffs this year. Now, it comes after Tesla said it would reduce its global headcount by more than 10%. And speaking of layoffs at Tesla, Elon Musk apologizing for its, quote, incorrectly low Tesla severance packages, and they said they're being fixed. And another hit for Tesla, getting a downgrade. Bloomberg's Kriti Gupta has those details.
Deutsche Bank downgrading it to a hold on the likelihood that the company will delay plans to produce its Model 2 mass market vehicle. That is coming from analyst Emmanuel Rosner, writing in a note that the previous buy rating was based on Tesla rolling out their 25,000 next-gen vehicle late next year. It would have helped out volumes, margins, free cash flow. He's saying if that doesn't happen, however, if there is a delay, you're going to see a really big effect on their bottom line.
And Tesla shares down 2%. Also, Alaska Air rebounding from its Boeing MAX issues. The carrier expects second quarter profits to top estimates. Right now, Alaska up 5%. That is your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, happy Friday Eve, everyone. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the analysis with our great analysts that cover 2,000 companies and 130 industries worldwide. We also cover all the world and national news right here with John Tucker. Hey, John.
All right, Alex, some hiccups as day 3 of jury selection underway in Donald Trump's criminal trial in Lower Manhattan. This morning, a juror that was picked this week was then excused after raising concerns about being fair. And now it appears there's a problem with juror number 4 and the truthfulness of at least one of his questionnaire answers. The prosecutor telling the judge the DA has come up with information, including a news article indicating the man was arrested back in 1994 for tearing down conservative political advertisements. President Biden accepting endorsements from at least 15 members of the Kennedy political family during a campaign stop in Philadelphia. Among them, Kerry Kennedy, a daughter of former Attorney General Robert F. Kennedy, niece of former President John F. Kennedy, and a sister of current presidential contender and third-party candidate Robert F. Kennedy, Jr.
We're doing that because we feel that the stakes are so high.
The bitter fight over salt continues. Advisors to Donald Trump want to cut the state and local tax write-off limit to below $10,000. More on that from Jeff Bellinger.
Stephen Moore and Arthur Laffer, who are regularly meeting with Trump to pitch him on economic policy ideas, say they are staunchly opposed to any increase to the $10,000 write-off cap on state and local taxes for salt. That limit was imposed in Trump's 2017 tax law and will expire at the end of 2025, along with other key portions of the law. Laffer says he is against any type of state and local deductions on the federal level. The $10,000 cap was felt most acutely in high-tax states, including New York and New Jersey. Jeff Bellinger, Bloomberg Radio.
And booming sales of cold drinks at Starbucks have created a problem. Growing amounts of plastic waste from these single-use cups. The coffee giant now says it plans to alleviate some of that waste with new disposable cups that contain up to 20% less plastic. The cups are set to be rolled out to stores in the U.S. and Canada starting this month. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg.
All right, let's get to the story we all really care about. Here's the title.
You didn't care about any of those.
I did. So sorry. So sorry. It's not personal.
Thanks.
Ozempic oops babies are now sparking a debate about the use as the drug as a fertility drug. So here's the deal. some women have been using Ozempic or Wegovy or Mounjaro, and they wind up getting pregnant. They were being treated for obesity, and then they end up getting pregnant instead. The drugs have also been started to use, the GLP-1 drugs, to treat polycystic ovary syndrome, which is one of the leading cause of infertility in U.S. women. And we just want to make sure it's safe. Like, if you use it while you're pregnant, is it still going to be safe for your baby? And it looks like potentially yes. And you could also use this for fertility, maybe, in men.
Is there nothing Ozempic can't do?
You're exactly.
Clearly not.
It's cancer. It's got, I mean, all things.
Heart
crazy.
disease.
Yep.
Everything else, liver, I don't know, all the stuff.
Well, speaking for a friend, those things work like crazy well. I mean, like in terms of curbing your appetite, like immediately. So if that's kind of what you're looking for, GLP-1 drugs have been marketed for nearly 20 years to treat diabetes, and their use in obesity is fueling a new market that's expected to hit $100 billion in 2030. So this has become just a huge business. The problem is companies haven't systematically studied GLP use across different issues as it relates to fertility, and don't plan to do anytime soon as well. In the absence of data, researchers are doing studies of their own to figure out if the drugs work for other issues as well. So there's been an issue out there about fertility, and apparently it's having an impact.
Yeah, I mean, and there was a study that found that the number of women that are exposed to GLP-1 drugs during pregnancy is increasing because a lot of them are turning to them for other conditions aside from weight loss, like diabetes, for example. Anecdotal thing here. Facebook group called I Got Pregnant on Ozempic has 597 members. On TikTok, dozens have said that they've become pregnant while taking the GLP-1 drug. I mean, ladies, be careful out there. All right, coming up, we'll talk about Blackstone earnings and an interview with John Gray of Blackstone with Paul Goldberg, Bloomberg Intelligence Senior Equity Analyst, on those earnings. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in on alternative asset manager Blackstone. They reported some numbers. We'll break them down with Paul Goldberg. He's the Bloomberg Intelligence equity analyst following all those alternative asset managers. Jason Kelly, Bloomberg Originals chief correspondent. He's going to join us to discuss the latest episode of his podcast, The Deal, with Alex Rodriguez and Jason Kelly. Always some cool guests that they sit down with. We met Alex Rodriguez last week.
Yeah, it was fun.
That was pretty fun. Nathan Dean's going to join us here. He's a Bloomberg Intelligence. He covers all the Washington, D.C. stuff. We got to talk about Ukraine, Israel, what's happening with our government. What are they going to pass and when are they going to pass it? He is the expert down in D.C., so we'll check in with him. But first, let's kick everything off with Charlie Pellet in the Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. We got a rally underway with the Dow up by almost 300 points right now. This update brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Treasury yields edged higher after solid economic data spurred bets that the Fed will be in no rush to cut rates. The S&P 500 index up 28 right now at 5,050. 50-50 right now on the S&P, up by about 0.6%. We've got the Dow Industrials up 298 now, up by about 0.8%. The Nasdaq Composite Index up 273, up by about 0.5%. The Nasdaq 100 Index up 0.4%. And yes, the Russell 2000 Index of small cap shares leading the way higher today. Small caps up by 1%. The 10-year 4.63% with the 2-year checking in at 4.98%. Spot gold now up 0.9%, $23.81 for an ounce of the precious metal, while West Texas Intermediate crude oil continues its retreat now at $82.25 a barrel. WTI right now lower by just about 0.5%. International Monetary Fund Managing Director Kristalina Georgieva says she is still sees the potential for the Federal Reserve to lower rates in 2024 And in a Bloomberg radio interview this morning, she said the Fed is doing the right thing by standing pat for now.
This being said, all eyes are on the United States. One, what is going to happen with inflation and interest rates? Two, how is the U.S. going to navigate this world of more intrusive government policies?
IMF's Kristalina Georgieva interview this morning on Bloomberg Radio. The big earnings report after the close of trading today will be Netflix. Investors have big expectations for the streaming giant's first quarter results. We've got Netflix shares ahead of that report, up now by 0.6%. We'll be all over those numbers when they break after the close of trading. Again, recapping, stocks higher. S&P right now up by 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. I don't get it, Paul. I don't get it. Stocks are higher, yields are higher, and gold is at a record.
Yes.
This does not make sense.
That does not
1
compute.
+ 1 + 1 is not equaling 3 to me.
Yeah, gold up another 0.9% here, $2,381. Wow.
You would think higher yields
Yes.
equals higher gold, okay. But why are we seeing higher stocks? You know who helped answer this? Abigail Doodle. She covers markets for Bloomberg News. Also, maybe it's a technical thing. I don't know. Abigail, why are we seeing this dynamic of gold at a record, higher yields, nearing 5% in the 2-year, and then higher stocks?
I think that investors are just in the mood for a little bit of a rally here, frankly, just a little bit of a relief. We've had such relentless selling pressure that it's sometimes, because there's not really any bad news right now, it gives just a little bit of an opening. Relative to yields being higher and stocks being higher, yields have been much higher than these levels, and stocks were higher at that point too. So I think that these levels on yields, why we haven't been there for a few months, they've been digested by stocks for quite some time. Relative to the S&P 500 and those technicals, I'd be surprised if this was the end of the selling. The index is right between its 50-day moving average and 100-day moving average, really kind of in a no man's land. You want to probably see it on more solid support, which is probably, I would say, just taking a quick glance here. Actually, I don't know. Maybe you can make the case that there is some support in there, not in terms of moving averages, but just support, but probably much stronger somewhere, you know, around 47. Between 46 and 4,700 is going to be where there's much stronger support. And by the way, that's actually, you know, not going to be too far away, depending on how long that did not take from the 200-day moving average. Not to say it necessarily happens, but that would be my guess right now.
Any particular stocks you're looking at here that are impacting the market?
You know, Las Vegas Sands is interesting. I don't think that there's so much. It's more of a story stock to me, but it's just interesting that you can have a company, and of course they have the casinos here in the U.S. and then over in China. But it's interesting that you can have a company that beats both revenue and adjusted earnings by more than 25%, and the stock is down. The last time I looked, 8%, the worst day in more than a year, and that has to do with Macau because their properties in Macau did not do as well, and in addition, the guidance looking forward, there's uncertainty for China and refurbishing the rooms. And the stock into today down 15%. So we now have the stock in a bear market. Once you start to see individual stocks in bear markets, it's only a period of time before the S&P 500 falls. So Las Vegas is relatively inconsequential. But let's take a look at Apple, because that stock, of course, I don't know what it's doing today. It's probably up. But that stock, of course, is in a correction from its last peak. And it's only up 0.1%. That's really the stock to keep an eye on. That's the stock that I'm completely fascinated by, because talking about support, if Apple goes below, I mean, the stock is down basically 15%. Once you have other stocks start to do that, it's going to be a problem. If Apple goes below, let's just call it 165, I think we're going to see Apple go down toward 100.
Wow.
Which is a big, yeah, that's a big, which would be macro, you know, but they have China, they have the Fed.
I mean, is it macro? It's just a China story. This is what Paul has been saying for a while, and I've come around to the fact that that's brilliant. It's just going to be a straight up China play at the end of the day.
Well, in terms of, I mean, the macro I'm talking about is the Fed. So like if the Fed, you know, if say there's no rate cuts, that's certainly going to play through all stocks and for sure Apple. But yes, the China piece on Apple, and then, you know, the one great thing that they have obviously going is their cash pile. But the growth isn't great, so if you have to own tech, you know, Apple's no longer, I hate to use the pun or the name, but it's no longer the shiny, fun, bright object.
Yeah, it's got some fundamental headwinds from sure.
Yeah, it does.
As it relates,
turning into old tech.
Yeah, particularly, it's just in my mind, I simplify it as just a play on China. They either figure out the demand side as an end market there for them? Will people start buying their stuff again?
Well, it's tough in China. I don't know if it sounds like you've done, but my understanding is that when people in China were really buying iPhones, they wanted like this was last year. This was the fanciest one. They want the top model. But now apparently there's competition. Like that status symbol of the Apple iPhone is not as strong in China, and apparently there's some competitors over there that have like they are.
Yeah, the competitive situation's it's gotten much more competitive there. Just looking at the ANR function for Apple, 31 buys, 20 holds, and 5 sells. So the street's kind of split on that as well. Abigail, thanks so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg, so we appreciate getting some of her thoughts there. Blackstone. I kind of don't remember how huge they are. And I go look at the market cap, I look at their assets under management. But anyway, we spoke with a Blackstone COO, Jonathan Gray, earlier today. He's concerned about higher rates are a headwind for Blackstone's key business units, limiting valuations and making borrowing costs more costly. And Blackstone COO Jonathan Gray thinks that the Fed may not be as quick to cut rates as investors hope. Let's listen in.
I think the Fed has had some real success on inflation. You know, we had inflation north of 9%.
Oh, that was Jonathan Gray.
Now it's 3.5%. The pace of disinflation has slowed, but the path is still downward.
Sorry about that. Did I just got in there? I thought he was done talking.
It was a little blip there.
Okay. That was Jonathan Gray, Blackstone COO. But all the hullabaloo, the stock was down like 5% earlier in pre-market trading, collected more fees from big retail funds and credit strategies during the first quarter, and that really helped to compensate for that slower pace of deal exits. But like some of these numbers are huge. Distributable earnings increased 1% from a year earlier to $1.27 billion.
Yep.
That's a ginormous kind of number.
Yeah.
Let's get
They pay their executives well, I understand.
I've heard such things, yes. Joining us now for more is Paul Goldberg, Bloomberg Intelligence Senior Equity Analyst. He covers all these big asset managers as well as global banks. Hey, Paul, what did you make of the numbers?
Hi, thank you for having me. The numbers, I would break them up in 3 buckets. One, the fee growth, which was fairly decent, but not the double-digit breakneck growth that we've seen in years prior to the painful 2023 and late 2022. The second one is key themes, and those things are getting better. So you do get a private credit business that was working pretty well. You have a wealth management business that you mentioned that's working pretty well. They reached $240 billion in assets in the wealth management with their goal of 250, so they're pretty much at their goal. And lastly, the painful part is the deal activity in terms of deployments and particularly realizations that produce performance fees. And that sort of becomes still a pain point for Blackstone, and that's a drag on their earnings.
Paul, what have they been saying about that? Because again, you're right, we haven't seen a lot of M&A activity. We haven't seen a lot of IPO activity, the types of exit events that would allow them to realize some returns on their investments. What are they saying about the next 6 to 12 months?
Well, I would actually look a little bit beyond that, because on the call they were really talking about 2024, and before they were really hopeful for the second half of 24 to get better. But then Jonathan Gray was actually on Bloomberg TV a little bit after the call in the last hour or so, and he kind of mentioned the more activity, the return of activity is probably going to be more of a late 24 and into 25 matter. So I would look a little bit beyond the next 6 months, maybe the next 9 to 12.
If they have a hard time exiting investments, how do they then raise more money for new funds? How does that work?
Well, I think it's the issue, not just we're kind of very focused on the private equity when we talk about that, but the third of their business is private equity, a third of their business is real estate, and there are some opportunities, and performance in real estate gotten a little bit better, so the fundraising came back to some extent, the BREIT, BCRED, the retail funds, the outflows kind of stopped there, so perpetual vehicles are doing pretty well for them. And the last category, the credit category, that's just been a very strong grower, and that's reached out about a third of their assets at this point.
Paul, yeah, you mentioned real estate, and of course, historically, Blackstone's been a big player in the real estate business. What is their call on office? A, do they have a lot of exposure there? And B, how concerned are they about it?
There was nothing discussed in terms of office really on the call this morning. They have about 1 or 2% of total assets in office space, maybe even less than that. So it's a fairly small amount. They are super focused on the multifamily. During the quarter, they made a $10 billion deal for Air Communities that take private deals. So they're still very focused on that. They've been up for over the last 10, 15 years. They also gave some specific numbers around the logistics and infrastructure. So there's about $50 billion of investments in that already. We're talking about that's 5% of the total assets, just in that.
So I had brought up how do they raise more money if they can't exit? Did you read the Big Take article, Paul Sweeney?
No.
It was about this. It was basically that private equity executives have had all the power in terms of fundraising, and then now the tables have turned a bit, and the deal makers are being told to put more of their own assets on the line as they struggle to raise cash from their increasingly wary backers, and that some of the junior guys have to like put up a home or like, you know, put up a car or their second home or something in order to get these loans with like very high rates in order to do that. Paul Goldberg, did you read that? What did you think of that?
I did read that. There is some of that. But on a net basis, there's still a lot of demand for all sorts of alternative investments, especially in the areas if you go into wealth where the growth is much faster and the opportunity is bigger because the wealth is a portion of the private investments. The portion of alternatives is much smaller. So there's a lot of opportunity there, and I think there's not as much power from the investors in those areas. There's a lot of demand coming from insurance companies. Blackstone has about $200 billion of their assets are coming from insurance. They earn them a little bit of extra spread. So I think there are different areas of fundraising and different areas of assets and clients that come to them rather than just what we kind of got from that article.
Private credit, Paul. What's Blackstone say about this business? It's obviously just a booming business. Assets under management are just skyrocketing. There's some calls for maybe some greater transparency, maybe even some regulation of the private credit business. What's the Blackstone take on that part of the business?
It's been very strong. As I mentioned, it reached about a third of their assets, $300+ billion. They do have a lot of different vehicles there. They do a lot of direct lending, but they also have the largest business development company, which is geared towards retail, BCRED. So that's a huge vehicle for them. There was a lot of growth. First quarter, there were actually some questions because you had a syndicated loan market, lending from the banks come back to some extent, reclaiming some of the mojo that the private credit got last year. But it's a long-term game. So over time, there's still a lot of opportunity for private credit. We ran some numbers, but if you think of investment grade and potential for replacement, especially for those insurance companies, it could be a $40 trillion addressable market. And private credit we're talking about 1.6, 1.7 trillion right now. So there's a lot of opportunity still to take the incremental 1 or 2 or 3% of that market still.
Before we let you go, so Blackstone set the tone. What do you think the other big asset managers are going to come out with?
It's a little bit difficult because the earnings for them kind of idiosyncratic to some extent because these are private investments. They're large and sometimes they move in different directions. There's about 2 weeks until the next one reports. So most of them reports over the end of April and early May. I think from what we've seen from Blackstone, the private credit is going to hold fairly well, which is a positive for companies like Apollo and Ares. Private equity realizations, exits are still a little bit more difficult, so it might give some pain to the guys like Carlyle. KKR, they actually pre-announced their realizations a few weeks before the end of the quarter, so we know the numbers were pretty light. So that's not going to be a surprise, but on the other hand, rates are staying higher for longer. They bought out the rest of the business from Global Atlantic, so the insurance business is going to do well and provide them some earnings in that area.
All right, Paul, thanks so much for joining us. Paul Goldberg, he's a senior equity analyst at Bloomberg Intelligence, following all the alternative asset managers. He's down in our Princeton, New Jersey office. So Blackstone is just so huge, and that private credit business has just been an amazing business. No surprise that Blackstone's got a big presence there.
You know, I was thinking about it. I was like, I don't know if I'm 100% clear what Blackstone is anymore.
Yeah.
Like, because it's so big.
I know.
I used to have a lot of lunches.
And remember, BlackRock used to be a part of that, to give you a sense of how big it originally was. Coming up, Jason Kelly, Bloomberg Originals chief correspondent, discusses the latest episode of his new podcast, The Deal, with Alex Rodriguez and Jason Kelly. His next guest is former NFL receiver Larry Fitzgerald. That's coming up. All right, folks, Bloomberg is now in your dashboard with Apple CarPlay and Android Auto. Want access to every Bloomberg podcast, live audio feeds, and the headlines at the click of a button. We'll download the latest version of the Bloomberg Business app now, and you're set to go. S&P 500 moving higher here, getting intraday highs up about 0.7%. The NASDAQ up about 0.6%. Yields also a little bit higher. 10-year Treasury, 4.62% on your 10-year. This is...
So, why don't you like her?
Two markets, one stocks.
Got it.
I think sports is really unique. There's not many businesses where, you go, to New York and, it'll be very difficult for,
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Charlie Pellet. We've got stocks powering higher right now with a 32-point gain for the S&P 500 index at 5,055, up by 0.6%. Dow Industrials up 318, up 0.8%. NASDAQ up 101 now, up 0.6%. The NASDAQ 100 index up 0.5%. Small cap shares with the Russell 2000 advancing 1.2%. The 10-year 4.63%. The 2-year at 4.6%. 0.98%. Spot gold today, we do have gold trading higher by another $23 the ounce. We're looking at a record here, $23.84 on gold, up by just about 1%. West Texas Intermediate crude down 0.5%, 82.25 right now for a barrel of WTI. Alaska Air Group expects second quarter profits will top analyst estimates, signaling that the carrier is recovering from a near catastrophe on one of its planes that triggered the temporary grounding of a key Boeing aircraft model. Shares of Alaska Airlines, they're up by 6.7% right now. Boeing higher as well today, up 0.9%. Again, recapping stocks higher, S&P right now up 0.7. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm sticking with the Jerry Garcia story. I don't care what anybody else says. Charlie Pello, thank you so much. We appreciate it. Alex Steele, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. Joined today by Jason Kelly, the Jason Kelly, chief correspondent for Bloomberg Originals and executive producer of a new podcast. It's called The Deal with Alex Rodriguez and Jason Kelly. On this week's episode of The Deal, Alex Rodriguez and Jason Kelly speak with former NFL wide receiver Larry Fitzgerald about how his football career gave him an early opportunities in business. Let's take a listen.
I think sports is really unique. There's not many businesses where, you go, to New York and, it'll be very difficult for, a financial advisor on the fifth floor to go upstairs and talk to Jamie Dimon and have a conversation with him. Like, it would be difficult, but you can do that in sports. You can go talk to, Mark Lazary. You can go talk to, Mark Cuban, some of the most successful business people in the world. You have direct access to them. And so why you would not utilize those opportunities makes no sense to me.
All right, that was NFL wide receiver Larry Fitzgerald speaking on this week's episode of The Deal with Alex Rodriguez and Jason Kelly. Jason, thanks so much for joining us here. Of course. Larry Fitzgerald, he had a phenomenal NFL career, a long NFL career, but he's got a lot of interest outside of that, doesn't he?
He's unbelievable. 17 years, one team, Arizona Cardinals, made it to one Super Bowl, didn't win, but a phenomenal human, went to University of Pittsburgh for a couple years before he went to the NFL, finished his degree at University of Phoenix. He lives there in the Phoenix area, splits his time actually between Phoenix and Minnesota, where he grew up. 160 companies he's invested in. By the way, he interned on Wall Street while he was a player. And he is a polymath. He's like this Renaissance man. We loved this conversation so much.
Wait, how did he do that? How did he do an internship and then also be a sports person at the same time?
So he literally, in the off season, went and interned with JP Morgan. Like, no kidding. He tells this great story in the episode about Frank Bisignano, who you've probably heard of, was then the chief operating officer of JP Morgan, now is the CEO of Fiserv. So Larry Fitzgerald meets Frank when he's 24 years old. And Frank is basically like, you need to mind your business. Like, you need to get into the business world now. And Larry's like, so smart. I'm a pretty good football player. Why do I need to do it now? And Frank's basically like, you got to set the foundation. And Larry says, what do I do? And he said, why don't you come be an intern? So he does that. And it just really sets him on this path to, he's looking at everything from mezzanine financing to real estate to venture capital to private equity and learning all this in the off season.
Does he have, what is he doing? Does he have a team that he's working with? How is he kind of making these investments?
Yeah, he has a pretty robust team around him. He has a lot of people who he consults with. He has also created this pretty unbelievable network. And as you guys know, once you're in that world, the opportunities start to come to you. You sort of get your rhythm of the types of things you want to invest in. He's a global investor, not just in tech, but also in sports. He's an owner of one of the professional cricket teams in India. He's invested in pickleball. He's a huge chess guy. He's an investor in chess.com, which was one of the most fun things I think we talked about in the whole episode.
Well, this is an interesting question because how is financial literacy and investment and protecting your money a theme among sports players? Like, with the super high-end guys, okay, but is there any help in how to manage all this wealth coming at you in a super short amount of time?
It's a great question. Yes and no. The leagues have gotten much smarter about this over time. The NFL and the NBA and Major League Baseball specifically have created these programs when you first come into the league, because even if you're coming in at the minimum, you're often getting more money than you've ever seen before in your life. And if you're on the upper echelon or in the upper echelon, you're getting generational wealth right off the bat. And so part of it is just like basic money management, but part of it is also investing for the long term and understanding that you may only play this professional sport for a very small number of years. The average tenure of an NFL player, so Larry Fitzgerald is an outlier, is 3.5 years.
Right. So basically, like, all your money is going to be made in 3.5 years. How
Yeah.
do you make it last your whole life?
Exactly. And how do you set yourself up, you know, to the Frank Bisignano case, how do you set yourself up to do something else? Because you may be done playing. I mean, even Larry Fitzgerald, who had this amazing career, was done when he was 40, you know? So, I mean, that's still pretty young.
You guys have done how many episodes now?
So this is episode 9.
And a lot of famous athletes and other folks in the business. What's like a Strahan and a Fitzgerald? I mean, what have you and Alex learned about kind of maybe some similarities or commonalities amongst these folks?
Yeah, I mean, I think one of the things we've definitely learned is that the men and women who have been the most successful figure out this way to apply the principles of being a top-level athlete to their business life. The other thing that I think they've learned is that, and this was a lesson that Magic Johnson taught to Alex Rodriguez, and Alex has taught it to many other people, which is, if you're a famous athlete, especially if you're like a Super Bowl winner or if you're a World Series winner, you can kind of get the meeting. People want to meet you. And so the key then is go in prepared, follow up, and then if you do that, there are lots and lots of opportunities open to you, because candidly, the expectations are pretty low. People are just like, this NFL player came to see me, no big deal, just wanted my advice. But then if that NFL player or Major League Baseball player then says, no, I want to be in business with you, I understand what you're doing, how can you help me and how can I help you? These are big relationships that really build up.
Do any of these players wind up uniting together to sort of like form funds to then go beef up what they have and their cred?
Yes, there are a few examples of that, and oftentimes what happens is they'll invest in a company together. Steve Young is a really good example of that. The former Hall of Fame 49ers quarterback, multiple Super Bowl winner. He has his own private equity fund that he created. He works with a number of other athletes, and he's actually hyper invested, Alex, in that exact question you brought up earlier about sort of like, how do you sort of pay it forward to the next generation and ensure that these players have that fundamental understanding of money management going forth in the world. And what he's tried to do is come up with some really interesting case studies that he can share, because not everybody's going to be a Larry Fitzgerald interning on Wall Street, but maybe you want to buy a franchise, maybe you want to do something with your business life to again sort of keep you going.
What's coming up on the deal?
So a couple, I think, really interesting episodes coming up next week. We'll hear from Mark Shapiro, so we'll get into your media world and ESPN and Endeavor. Lots of great stories there. We have Serena Williams coming up in a few weeks, and we taped last week when Alex was here with me with Stephen A. Smith. Some fireworks coming up.
Yeah, I mean, and no one has converted their athletic success into business success than Alex Rodriguez.
Totally.
I mean, so his questioning must be very informed to these people, because he knows exactly what the risks and opportunities are.
100%. And he knows all of the things, Alex, that you've been bringing up about, how do you suss out the other athletes who are sort of like-minded? Because not all of them are. Ndamukong Suh told me a story years ago about how he would go into a locker room when he got to a new team and be like, all right, guys, we're going to do some business. And a lot of people would be like, no, I'm good. But thanks, though. Like, good luck with your real estate investing, but I'm going to just go, play football here.
Right. No, fair enough. Really cool.
Yeah.
Great stuff, Jason.
Thank
you so much. Jason Kelly, chief correspondent for Bloomberg Originals and executive producer of the new podcast.
Yeah, and on this week's episode of The Deal with Alex Rodriguez and Jason Kelly, they sit down with former NFL wide receiver Larry Fitzgerald, and they talk about his football career and how it gave him opportunities in business and lots of good stuff there. Jason, thanks so much for joining us. I'm looking at this market. I don't know, we're still up today.
I know. I don't get it. I still don't get it. I think if you have higher yields and you have gold, something doesn't sit right. Something feels confusing. I started to read the articles about CTAs and stuff, and how, CTAs pushed up the market, and then they're going to push it down on the way down. When I start to read the CTA stuff, I'm like, okay. Now we're just looking for reasons to explain some moves.
Well, I'm looking at the WIRP function, World Interest Rate Probability. The market's dialed back its interest rate cut forecast. We're now, remember, we started the year thinking about maybe 6 rate cuts here. We're sitting here by year end, maybe 1.5 is kind of where the market is right here. So the market's dialed back its expectations. And we see that clearly in the bond market with yields pushing higher. The 2-year Treasury, 4.98%. We did hit 5% a few days ago. So the bond market is getting the message.
Oh, yeah.
But the equity markets, we had a drawdown of 4% off of the high over the last 4 or 5 trading days. Is that it? I don't know. A lot of folks felt like you needed to see more, but anyway.
Yeah. And at the same time, the IMF warning yesterday that the U.S. is in like an unsustainable fiscal position and sort of warning on that point. We're going to speak to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, coming up next. This is Bloomberg.
All right, world and national news in New York City. Here is Mr. John Tucker.
All right, Paul and Alex, day 3 of former President Donald Trump's criminal trial in Lower Manhattan. After 7 people were selected to serve on Tuesday, there was optimism. The full jury could be seated by Friday, and opening arguments could start as soon as Monday. But after one juror came in this morning and said she couldn't be fair after all, and another went AWOL, it looks like they're back to just 5 jurors. The Biden administration has imposed fresh sanctions on Iran over its April 13th strike into Israel, targeting a company that made the engine type used in drones launched in the barrage. Treasury Secretary Janet Yellen said in a statement, they're using Treasury's economic tools to degrade and disrupt key aspects of Iran's malign activity. Republicans have upheld the Arizona abortion ban. More on that story from Bloomberg's Stephen Potisk.
Republicans in the Arizona State House blocked 2 attempts Wednesday to repeal the state's 160-year-old near-total ban on abortion, despite pressure on the GOP, including from former President Donald Trump, to change course on the hot-button issue. But later in the day, 2 Senate Republicans joined with Democrats enough to create a majority to move forward with their version of a repeal. A final vote on the bill could be weeks away. If the Senate does ultimately vote to repeal the ban, the measure would go back to the House, where it would still face a difficult path. Steve Potisk, Bloomberg Radio.
Crime and punishment may be on the ballot in California Election Day. A coalition seeking to revamp California's landmark criminal justice law says it's collected enough signatures to qualify for November's ballot. The proposed Homeless, Drug Addiction, and Theft Reduction Act seeks to roll back parts of Proposition 47. That's a law passed in 2014 that reduced punishments for some lower-level crimes. Global news 24 hours a day. Whenever you want it with Bloomberg News Now, I'm John Tucker, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are off session highs, and we begin with a developing story. Headline right now on the Bloomberg Professional Service. Brevin Howard cutting more than 100 employees to reduce costs. That is the headline right now. We'll get you more details as they become available. The Dow, the S&P, NASDAQ are all advancing. Treasury yields are also edging higher after solid economic data this morning spurred bets that the Fed will be in no rush to cut rates. S&P up 22 at 5,044. That is a gain right now of 0.4%. Dow Industrials up 234, up 0.6. We've got NASDAQ up 63, a gain there of 0.4%. 10-year 4.63% with a 2-year at 4.98%. Spot gold up $21 the ounce to $23.82 the ounce, up 0.9%. While West Texas Intermediate crude little changed, up 12 cents a barrel, 82.81 right now on WTI. Weekly jobless claims are holding steady, consistent with a stable U.S. labor market. And with that story, here's Bloomberg's Vinny Del Giudice.
212,000 jobless claims. That's the fresh tally, and it remains near historic lows, even with this year's high-profile corporate culling. Continuing claims, a proxy for the number of Americans receiving unemployment checks, are also little changed. Bloomberg Economics has issued a cautious note on the data, saying some parts of the U.S. are in better shape than others. Vinny Del Giudice, Bloomberg Radio.
After the bell, Netflix. Investors do have big expectations for the streaming giant's first quarter results. Ahead of that report, Netflix shares up now by 0.3%. Recapping, S&P up 0.5%. 10-year yield right now is at 4.63%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate it. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Alex, looking just on the Bloomberg terminal, got an IPO price today. Ibotta Inc., a digital marketing software firm that counts Walmart as a backer, and a group of shareholders raised about $577 million initial public offering, priced above its targeted range. I guess it priced at $88 a share. Looking at the indications right here, 110 to 115 are the indicated. It hasn't traded open for trading yet, but indicated higher after pricing at the high end of the range. So another good sign. And the Bloomberg reporting is saying that the IPOs year to date are running at about triple the level of the same period last year. So maybe a good sign for the market's a good sign, certainly for the investment banks, and good sign for investors looking to cash out. So we'll keep an eye on that trade here.
Yeah, that's something.
Yep. Nathan Dean joins us. He's our senior policy analyst for Bloomberg Intelligence. He is the only rational, smart person I know in Washington, D.C., folks. And then we go to him whenever we need a little guidance here. Nathan, busy times down in D.C. I think your Congress is back at work. I mean, all their various vacations are done here. They got to get some work done here. Talk to us about where we are with some of these aid bills to Ukraine and Israel and some of these other issues that are, I guess, top of mind.
Yeah, so, obviously this week has all been about Ukraine and Israel aid, and what Speaker Mike Johnson is doing is essentially putting 4 bills to the floor on Saturday. They need 72 hours to read the legislation, and this would provide about $95.3 billion in aid to Ukraine, Israel, and Taiwan. Now, in terms of the nuggets, who are the winners of this bill? Well, this is very similar to the Senate-passed package, but the Ukraine aid favors RTX and General Dynamics because there's about $25 billion in there to resupply weapons and munitions. When it comes to Israel, it's just there's about $5.2 billion in there for the replenishment of the Israeli-operated missile systems, but the Israeli conflict continues to favor Boeing and Lockheed Martin because they would like to purchase, or Israel has voiced support for purchasing about 50 F-15 fighters. So this is certainly contractor week. Now, where do we think this is going to go?